Hello everyone. Just checking if you are live yet. For those who've already joined, just let me know if I'm audible and visible. I've started this a little early just to make sure we have done the checks and we can start right on time. For all those of you who've joined, just let me know if I'm audible and visible, and then we'll keep moving ahead. Hello Ruchi. I'm perfectly audible and visible. Do let me know. If yes, I'll just quickly get started. Hi Pooja, hi Ruchi. I'm audible? Perfect. Cool. Hi Parvesh. Welcome back. Super. Let's not waste any time. We'll get started. Hello everyone. Hope all is well. And welcome back to the second day of this revision marathon of ACCA financial management subject for all those of you who are appearing in June 2026 and beyond exams. Now, very quickly, what we had covered yesterday, we'll start with that, whatever we had covered yesterday. So what we covered yesterday is the topic of investment appraisal, which is chapter 2 to chapter 6 of my notes. Two chapters of business finance, which is chapter 16 and chapter 17, and I had asked you all to do the self study for chapter 1, 11 and 12 from my notes. I had shared all of these notes yesterday on my Telegram channel, and the link of the Telegram channel is also given in the description of this video. So if you are someone who's directly watching this video, of course you can start with this video as a revision, and you can then watch the first video, the link of which is already given in the YouTube description of this channel. Okay, what we plan to cover today, at the outset I'll tell you what all we plan to cover, and let's see what all we can achieve. But at the bare minimum, I want to cover the remaining chapters of, so of course capital structure, which is chapter 18, I want to cover. We'll see if we get time to cover financial ratios as well. Otherwise, I think ratios is something you are anyways well equipped from an FR perspective, but we'll definitely try to cover that as well. And most importantly, guys, section G, which is risk management, is what we will be planning to cover. So let's get started. We'll see where we get to, but the hope is to cover 100% of the course, so don't worry. Okay, any questions, any comments, please let me know. Hi Bhaga, good to see you back as well. Is the background noise bothering a lot? I can't do much about it. It's the AC. I can't put it off. I have the fan off, but it's the AC, so I hope it's not bothering a lot. Okay, cool. Quickly getting started, guys. We had discussed yesterday how to calculate the weighted average cost of capital, how to find out the cost of debt, how to find out the cost of preference shares, how to find out the cost of equity as well. So we had covered all of that. Now let us discuss how to get to that ideal level of capital structure. How much debt should we have in the capital structure? How much equity should we have in the capital structure? But before that, remember, I had told you there are two types of risk. Primarily, there is a business risk, which is relating to our operations, operating risk. I'd given an example of restaurants. And the second type of risk, which is financial risk, which relates to you having a debt as a part of your capital structure. Because when you have debt as a part of your capital structure, what happens is at that point in time, you will invariably end up taking a financial risk. There is a risk that your company will not be able to meet the obligations, whether interest or the fixed repayment obligations, and you might become insolvent, in which case there's this financial risk that you face. So in this chapter, let us understand what does the ideal capital structure look like. But before that, let us understand the concept of gearing. I kept using the word gearing a lot yesterday, and for some of you who've not read this chapter, probably might be wondering what gearing is. So there's operating gearing, and then there is financial gearing as well, which represents both business risk and financial risk respectively. Operating risk, of course, measures the extent to which firms' operating costs are fixed. Okay, it measures the extent to which the operating costs are fixed. Now if you see, there's an example also given before I come to the formula. If you see an example, right, there's an alpha and a beta co, right? Both have $8 million of revenue. Both have $8 million of revenue, but Alpha Co has, out of the total 7 million expenses, it has 6 million which is variable. Okay, versus Beta Co has only 2 million variable. Total expenses being the same, it has only 2 million variable and 5 is fixed. What happens is with 15% revenue increase, what happens? 8 becomes for both, 8 becomes 9.2 for both. 8 becomes 9.2 for both. Now variable cost, of course, will also increase. Variable cost becomes 6.9 over here, which is a 15% increase, and it becomes 2.3 over here, which is also a 15% increase, correct? But fixed cost being the same, fixed costs being the same, let us see how the profitability looks like. What your EBIT changes to, your EBIT changes to is 9.2 minus 7.9 in first case for alpha, which means a 30% increase, a 30% increase versus the original 30% increase. And in this case for beta, what happens is 9.2 minus 2.3 minus 5 will be 1.9. So you see 90% is the increase in 90% is the increase in EBIT because of only a 15% increase in revenue. Why does this happen? This happens because of fixed cost, because fixed costs do not increase in line with your revenue. Okay, the higher the fixed cost, the higher is your operating gearing, and hence your magnification of EBIT for every unit of increase in revenue is higher. So sir, everyone will say, let us make all costs fixed costs, why should we even keep variable cost in the business? But guys, similar will be an amplification in case of a downside as well. If your revenues were to drop, your EBIT will vanish really fast. If you were to have a really fixed cost, really high fixed cost, then your EBITs will vanish very fast as well. So it's a high risk, high return journey. Higher the fixed cost, higher is the volatility and higher is the business risk. So this is what we mean by operating gearing. That is the extent to which your fixed costs or extent to which your costs are comprising of your fixed costs. First of all guys, for all those of you attending live, if you've not liked this video already, please do like. And I'm not seeking likes here for myself, but I'm seeking likes over here so that it can also reach to those people who are coming across this video for the first time and they know that this video can be helpful for them. And needless to say, if you've not subscribed, do subscribe to this channel as well, because there'll be a lot more coming your way. Coming back, so what could be the formula for deciding what is operating gearing? The formulas could be 4 formulas, but the answer should be broadly the same, at least in the direction, the degree of operating leverage. So number 1 will be your fixed cost to variable cost, number 2 will be fixed cost to total cost, number 3 will be percentage change in EBIT. So in this case, for example, 30% change in EBIT divided by 15% change in EBIT, and for the second case it will be 90% divided by 15%. Okay, that'll be the third formula, and fourth formula could be contribution divided by EBIT. So these are all the 4 formulas which tell you what is the extent to which your cost structure has fixed cost, or what is the operating gearing in the business. Okay, now quickly moving to financial gearing, which I keep referring to. Financial gearing is effectively the extent of debt in your business, the extent of debt in your business in the part of your capital structure. Okay, now the higher the debt, the higher is the financial risk. We've also discussed this. So if you look at it from an equity perspective, it refers to long-term debt and preference shares in the numerator. Guys, yesterday also I told you preference shares are like debt because the obligation is fixed. You have to pay that dividend, you have to pay that share capital back at least before you pay the share, the ordinary equity shareholders, and hence both will be in the numerator. This could be a common source of error. And number 2, if you look at it from a total capital perspective, of course if you look at it from an equity perspective, it will be ordinary share capital plus reserves, but total capital will be total long-term capital, where total long-term capital will be debt plus preference shares plus equity. And of course equity here includes your ordinary share capital as well as your reserve. So these are the formulas for financial gearing. There's another formula which talks about your interest gearing, which basically in some shape or form also talks about it. It's almost the reverse of interest coverage ratio. We know interest coverage ratio talks about EBIT upon interest, right? Over here it says the reverse of that, interest divided by EBIT, which talks about your interest gearing. It basically tries to say that to what extent the lower this ratio, the lower the interest ratio, interest gearing ratio, the better it is for you, which means that you have 100 rupees of income, but you have to pay only 10 as interest. But if you have 100 rupees of income and you have to pay 80 rupees of that as the interest, then it is a big risk, because if your income goes down even slightly, then your cash flow is at a risk. Okay, preference shares are treated as a debt is important, and interest gearing is a P&L measure. Remember, it is a P&L measure rather than a balance sheet measure. Both of these are balance sheet measures, but this is a P&L measure. Okay, it shows what percent of our profit and loss is absorbed by interest payments, and all 3 are from a different perspective. Now, which one should you go for? Should you go for market value or should you go for a book value? We've discussed this yesterday. From the perspective of WACC calculations, you should always use market value, and hence accordingly you should also use market values from a perspective of gearing, because that is how it is more relevant. It is more relevant. But of course sometimes what might happen is, if your share price is artificially inflated or deflated and it does not give the right picture, if it is artificially inflated or deflated and does not give the right picture, you might also want to calculate the the gearing from a book value perspective, and that could well happen. Okay. Now this is a calculation of the financial gearing. I'm not going on to calculate this. It is super simple calculations. You know this. Risk return trade-off, guys. We've discussed this risk return trade-off. So business risk, right? Business risk goes to operating risk, right? Extent of fixed cost. Then there is financial gearing as well, which also feeds into your business risk. Okay. So business risk is largely determined by the industry and the nature of operations. Operating gearing will be influenced by the industry. Again, for example, airlines have high fixed cost versus, let's say, a consultancy, which is an accountant, will have a very low fixed cost, right? Comparatively, of course. Financial gearing is the most controllable risk factor. Why? Because you can decide the extent of debt you want to keep. Do you want to keep more debt, or do you want to keep more equity in the business? Business risk and operating gearing are really less controllable. Operating gearing still to some extent. Business risk is of course not controllable, because you as an airline, you cannot decide how much fixed cost to have. You cannot ask that all my costs be variable. It will be invariably fixed. If you fly a plane, whether there are 20 passengers or whether there are 100 passengers, your fixed cost of fuel will be the same. Okay. So from a financial manager's perspective, that is from your perspective as the future CFO, you will have to make sure that the overall risk from an equity investor perspective, your shareholders' overall risk is acceptable to your shareholder, acceptable in context of the rate of return that they demand. And remember, rate of return and risk are always, they go hand in hand. Higher the risk, higher the return expectations. So you would want to make sure that given the return expectations, you take only that much amount of risk that they can manage. Okay. And of course, this risk determines rate of return. Cost of equity effectively determines WACC, which determines the market value of the company. Guys, the market value of a company is nothing but the present value of all its future cash flows. I hope this is making sense. Okay. Now, there's little a financial manager can do to alter the business risk, and there are very limited opportunities to change the operating gearing, and therefore the risk associated with financing is the main controllable element. Okay, I hope this is clear. How do you calculate the value of the company? And we'll be covering the chapter of business valuation in detail as well. But let us first talk about how do we calculate the value of the company. So basically, it is as simple as future cash flows that the investors will get divided by the WACC. All the future cash flows that will go to all the capital providers divided by the WACC of the business. This is nothing but the perpetuity formula which we had discussed yesterday. Okay. The only thing is, can we reduce the WACC by changing the gearing ratio? Yes, the answer is yes. Now we'll come to how do we change the gearing ratio and to what extent should it make sense to change the gearing ratio. Because why? Now this is very important. Why is it important to have the right capital structure? Because the right capital structure will have the right financial risk. The right capital structure will have the right WACC. And the right WACC will make sure that you are able to appraise your investments correctly. If it is WACC is very high, then a lot of investments you will have to pass because the NPV will become negative. WACC will also determine what the wealth of the shareholders is, because they will determine the market value. The WACC will determine the market value of equity, and because of that, it will affect the shareholders' wealth. And of course, if it is positive NPV project, then it affects the shareholders' wealth. Why is debt cheaper significantly than equity? I think it's I've been saying this since yesterday. Two reasons. Low risk, debt has a low risk, and hence it is low risk, and hence the return required by the debt holders is also low. And number two, you get the tax shield on the interest payment. So these are the key two reasons why debt is cheaper. But having said that, there is also a cost of having debt. What is the cost? That if you introduce the debt, the risk from an equity shareholder perspective, increases, and hence the KE increases. We also saw yesterday that the beta of equity is higher as compared to the beta of asset. Why? Beta of asset is nothing but the unlevered beta. Beta of equity is the levered beta. Because when you have a debt, your overall risk of the business increases. Okay, and if your beta of equity is higher, it feeds into KE. So KE of a levered company. What do we mean by levered company? One that has a debt will be higher than KE of a unlevered company. When you have no debt in the business, then your financial risk is also low. If the financial risk is low, then your requirement from equity shareholder perspective will also be lower. So which of the effect dominates? On one hand, you have the benefit of cheaper debt. Again, why is debt cheaper? Because low risk and because tax shield. So on one hand, debt is cheaper. But on the other hand, there is a cost of debt that when you introduce the debt, the cost of equity goes up. So then you have a lower number and you have a higher number. So overall average, is it lower or higher is the key question. So is the benefit outweighing the cost? And effectively, does the WACC rise or fall? This is the fundamental question that the capital structure theories and effectively hence this chapter will be enabling you to answer. Is it clear till here? Is it clear till here? Have you ever thought logically why we are even studying this chapter? This was the entire logic why we are even studying the chapter of business finance, capital structure, and cost of equity, debt, and so on and so forth. Is it clear? I'll take a 20, 25 second, 30-second pause to see if it is all clear till here. And all those of you who joined yesterday, just put a thumbs up, hi, yes, anything works. If you have a question, also feel free to ask on the chat box. And I'm glad, by the way, once again, all those of you who've come, I know today is a Sunday, it's Sunday evening, and yet you've made time to join. So I think this definitely shows your commitment, and this will go a long way in helping you clear the exams. You will definitely be happy. I think when you solve the paper, especially section A and B questions, even section C, but when you solve the section A and B questions, right, you will definitely be able to recollect a lot of these words. By the way, for example, why is debt cheaper than equity? And the fact that there is a cost. This question was there in the pre-mock June 26 exams. So when you actually pay attention and when you start understanding concepts, even if you've not mugged up theory, a lot of students ask me, sir, how do I prepare theory from a financial management perspective? And my answer is, see, of course, to be honest, you'll have to also learn the theory a little bit, but honestly, as long as you've understood the theory very well, trust me on this, you will be able to write in the examinations. And if you're writing logically, right, the ACCA Institute will give you those marks. Even if the answer does not match exactly the suggested answers, then trust me, it does not exactly have to, right, as long as you've written logically. So I see some yeses from Ruchi, Pooja, Bhargav, Parvesh, Nizia. Super. Kudos, guys. Stay with me, keep saying yes. If there's a question, just keep putting it in the chat box so that I know I'm making sense, so that I know that you guys are live and listening to me. Okay, not alive, live as in watching with me. Now the next thing is, by the way, guys, one thing that I will suggest you, one thing that I've anyways taken a pause, one thing that I want to really give you as a recommendation today. There are some 11 days to go for the examination. There's some 11 days to go for the examination. One free tip that I'm giving you right now is, of course, needless to say, this is not a free tip that I'm talking about, but you should practice at least, and this is at least 3 mocks on the practice platform. 3 mocks on the practice platform you should practice, right? Why? It is important for you to set yourself in that exam environment, do it, solve it in those 3 hours, right? Solve it on the practice platform so that you familiarize yourself with the word processor, familiarize yourself with the spreadsheet. If there's a section AB question where you have to go to the spreadsheet and solve it, you familiarize yourself with all the movement over there, okay? But this is not the free tip I'm talking about. The free tip here is, from today to your exam day, there'll of course be a lot of questions that you'll study, you will revise, and so on and so forth, especially section C questions, right? Also section A and B, but more so section C questions. You will make a lot of mistakes. Right? But first of all, know the fact that it is important to make a mistake, or it is okay to make a mistake. So if you're making a mistake, don't be afraid that, oh, I have committed a blunder. It's okay, right? But more importantly, what you should do is you should keep a mistake tracker. For example, one of the mistakes could be that I told you yesterday, could be a mistake that when you compute sensitivity, one tends to forget the tax implication. So maybe this is the mistake. Now, if you note it down and refer to this mistake tracker the day before exam, that I had forgotten the tax consideration when I was considering the sensitivity, during the exam, you'll definitely remember this is not a mistake that I want to repeat. Okay, this is definitely one mistake that you would not want to repeat. Number 2, another example of a mistake, for example, tax, right? Instead of arrears, you say I will keep it in the same year. You keep it in the same year. Now this is a mistake that you might end up making, right? Now, in the exam you will remember, if you've kept a mistake tracker and you refer to the mistake tracker the day before exam, this mistake tracker, then you will be able to remember that this is not a mistake that I want to comment again. So first of all, solve as many sums and of course 3 mock tests at least between today and the day before the exam. But also guys, try to keep a tracker of the mistake, otherwise it wouldn't make sense, right? You know, junior of mine who's made it to IIM Ahmedabad right now used to keep saying, if it is not documented, it is not done. So whenever you are solving something, try to document all your mistakes, only then you'll be able to extract the most value out of it. Okay, I hope this is helpful. Just give a thumbs up if this is helpful. Now quickly getting started with the capital structure theories. The first one is, yes, this will be available later as well. Someone has asked me, will the live video be available later? Absolutely, this will be available. The first day's video is also available, but having said that, I would really prefer if you all can attend live, because that just helps you with the discipline of being able to attend live. Plus of course you'll be able to ask any doubts if there are. Okay, yeah. Coming back, so the traditional view of capital structure is what? This is the traditional view, which is also called as the intuitive view or the common sense view, which by the way, a big assumption is it ignores the taxation. It ignores the taxation. It says very simply that WACC follows a U-shaped pattern. It says up to a particular point in time, as the cost of debt reduces, your overall WACC will come down, right? Cost of debt, for example, let's say you earlier had 20% debt, right? 20% debt. Your debt was, let's say, 10%. Cost of debt was 10%. You had 80% equity. And cost of equity was 20%. Okay. So this number, let's say, what is the average? The 16 plus 2, 18%. Hypothetically, 18% is the average. Now, your debt increased to, let's say, 40%. Your debt increased to 40%. Maybe the 10% became 11%. And for the equity, that 60%, the cost of equity probably rose to hypothetically a 21%, right? Let's say 21%. So 21% into 60%, which is 12.6. 12.6 plus 4.4 will give you 17%. So as you can see, your cost of WACC has gone down. Even though the fact that cost of debt and cost of equity have individually gone up. Why does this happen? This happens because you've increased the proportion of debt and equity. Now further, as you increase the debt to 60% of your capital and equity to 40%, now the risk for both debt holders as well as equity holders really increases. So debt holders will say, now I want 13%, or maybe now I want 14%. Your equity shareholders will say, now I want 24%. The risk for both of them has really increased. So 14 into 60%. 14 into 60% plus 24 into 40%, or let's say, you know, let me make this 25 and 15%. So 60 into 15%, which is 9, plus 40 into 25%. Now it becomes 19%. This was 17%. So up to a particular point in time, if you increase the debt, up to a particular point in time, your WACC falls, because while KE is rising. Why will KE rise? Why will the cost of equity rise? Because the financial risk has increased. But only at a certain point, the reduction in the WACC because of the cost of debt is still higher. But at a very high level of gearing, the equity shareholders will say, now the risk is really going too high, the financial risk is too high, and hence KE rises faster than at the low gearing levels, and the WACC starts to rise. So this is when the WACC starts to rise. So there is this one point where, this is the one point where your WACC is the minimum. There is this one point post which both KE and KD start rising. Okay. And what happens to the market value? The market value is of course inversely proportionate. The higher your WACC, the lower your market value, the lower your WACC, the higher your market value. So your market value of the equity is highest at this point, which corresponds to this point. Okay, so effectively the conclusion of the traditional value, this conclusion is the most important. There is an optimal level of gearing, which is point X, where the overall return required is minimized, which means the WACC is minimized. Overall return required, effectively the return for shareholders or the debt holders, which is effectively the capital providers, is the same as WACC. So if it is minimum, the return required is minimum, the WACC is also minimum, which means the combined market value is maximized. Okay, so implication for finance, implication for you as the future CFO is what? Implication for you as a future CFO is you keep gearing up until you reach the optimal point, and then you maintain this level of gearing. If you are raising new finance, you raise it in the same mix. Otherwise, if the level changes, then the WACC will increase. Okay, However, the problem is there is no practical method to do this calculation. What is this point tax? It is very difficult to calculate. So there's an example given also which says at 20%, this is just an example, there's no right number. At 20%, the WACC is the lowest. As you see, the KE keeps rising, that KD also keeps rising, and yet this is the right point post which over here with the rise in gearing, despite the fact that this is lower than this, 10% is lower than 19.5%, your WACC overall is higher as compared to 13.41. Okay, so this is the first theory, which is the traditional view theory. What I will try and do is try to pay attention to these theories. What I will try and ask is, I will jumble it up and I will ask you which of these is the theory that I am referring to, and I want you to put it in the chat box. This is how I'll make sure if you guys are paying attention or not. Now, Modigliani-Miller approach. Remember, the first theory of Modigliani-Miller approach assumed there is no taxation. It said capital structure is irrelevant to the company value. It says WACC stays the same because if my KD reduces, KE increases to the same proportion to make sure that the overall debt, to make sure that the overall WACC remains the same. So it says the increase in KE exactly offsets the benefit of the cheaper finance, and hence the WACC remains unchanged. So basically it says the new KE is effectively the old KE is what? Ungeared KE plus K0 minus KD, which is what? Which is the difference between unlevered cost of equity and the cost of debt multiplied by debt by equity. So there's a formula. This formula basically is also derived from ratio proportions only if you think about it. The exact extent of difference jitna whatever debt is lower as compared to the cost of equity, that we will increase in the cost of equity itself. So this shows that KE actually increases linearly with gearing. So Modigliani-Miller said what? They said, by the way, there's one Modigliani-Miller approach in the dividend itself. Do you remember? Can you put it in the chat box what Modigliani-Miller said about dividends? Can you put it in the chat box very quickly? It's a quick test about whether you remember what we discussed and studied yesterday. It was in chapter number 16 about the dividend policy. Modigliani-Miller also said something about the dividend policy. I'll wait for 30 seconds. I will wait, guys. I know I'm testing you. You would not expect this to come from me, but I think this is needed. I also want you to be preparing for the examination, not just keep and watch this. Otherwise, this is my revision, not your revision, guys. Do you remember, does anyone remember what Modigliani-Miller said about the dividend policy? I'm hoping at least some of you remember. Which means if you don't remember, and if I don't see the chat box, which means that you guys have not gone back and revised. I had asked you to do one homework, which was whatever we studied in the class, you should quickly at least run through my notes to revise. Otherwise, if I am speaking and you are just watching this video, and this is a hard reality check for you guys, just watching this video, then somehow it's just my revision. Your revision will happen only if you sit with the notes and read it at your end also. Okay, it is irrelevant in market value. Yes. So Modigliani-Miller said that dividend is irrelevant to the total wealth of the shareholders. Dividend is irrelevant if perfect market conditions exist, because if they don't give the dividend, then the share price will increase to that extent and the total wealth of the shareholders remain the same. Okay. Similarly, they are saying over here also what happens, the WACC remains the same, and hence the value of company as you see remains the same over here because KE rises in proportion. Okay, so implication for finance is superb. I think few of you have replied superb. I'm glad some of you remember. So the implication for finance of the Modigliani-Miller no taxation theory is that you use any mix of debt and equity, it does not matter, it is irrelevant. Okay, and these are the assumptions, which is perfect capital markets. These could be tested in section A and B also. Perfect capital markets, and at least some of these are very generic assumptions, which is almost always there. No taxation, perfect capital markets, no transaction costs, and so on and so forth. So some of these assumptions, even if you don't remember any, at least the generic ones you can remember. And generic ones, as in, for example, no taxation is not an assumption in all the theories. In fact, even in immediately the next theory, this assumption will change. But at least perfect capital markets, no transaction costs is typically an assumption that is there everywhere. Okay. Now these assumptions are clearly unrealistic because you always will have taxation, you always will have transaction costs. There will never be perfect capital markets, right? Just given an example also which says that overall your value remains unchanged. Your WACC, new WACC is the same as what your old WACC or your cost of equity was. Now, because the taxation comes into picture. Because the taxation came into picture, Modigliani-Miller said yes. Now, tax shield will be available on the debt interest. So debt interest is tax deductible. So there will always be some positive effect because of you taking the debt. This will be a tax shield effect. So what is that starting point? They said the investors are rational, and the return on equity is directly linked to the increase in gearing, which is exactly what they said in the previous one. So they said the cost of equity directly increases in the proportion of cost of debt, but there is a benefit to the extent of that tax shield. When you put in that effect, effect, it will be linearly correlated but not exactly. So it will move in the same it will move in the same direction, or I would say move in the opposite direction. If your cost of debt, as you increase the cost of debt, your cost of as you increase the proportion of debt, your cost of equity will keep increasing, but not in the same speed. So it does not fully offset the benefit of the tax adjusted cheaper finance, which means as you keep increasing the debt, the gearing increases. So according to them, now you can have as higher debt as possible, have 99.9999% debt. Okay, so they are saying you keep increasing the debt, the ACC will keep falling down, because while it is increasing linearly with gearing, it is increasing at a slower rate. So WACC which keep reducing, and company value will keep increasing. So it says conclusion is you can have 99.99, effectively 100%, but you need to have some equity, right? So it says you should use as much debt as possible. This is Modigliani-Miller approach with taxation. It says use as much debt as possible, but realistically, will you do that? No, you will say, oh, there is a lot of financial risk. Why would we take that big risk? Okay, so they say the value of a geared company is nothing but a value of an ungeared company plus the tax shield. The tax shield is what? Tax shield is effectively the tax rate into the market value of debt. The tax shield is nothing but the present value of the tax shield is nothing but the tax rate into the market value of debt. Okay, I hope this is clear. But of course, what are the real life problems? Why do companies not use 99.9% debt? You think about it very logically, even if you don't see the answer. First of all, the assumption itself, investors are not rational, markets are not perfect, financial risk really increases, so there's a huge bankruptcy cost. Think about it more. So for example, if your debt keeps increasing, then what happens? The risk of equity shareholders will be very high, so they will not take that much of risk. Your KE will keep increasing because the risk is increasing. The debt holders will not allow you. There'll be a restriction to the extent of debt that you can take. There'll be covenants. Taxes also, you will have only so much profits against which you will be able to offset the interest, right? So all of these reasons are there. Bankruptcy risk, agency cost, which is lenders will impose some covenants, tax exhaustion. There'll be a debt capacity. You'll have only so many assets that you can mortgage. Risk tolerance, directors will be more risk averse. Legal restrictions, which is article of association, may limit borrowing. And finally, rising cost, which is KD increases as gearing increases. So the practical outcome will be what? Companies end up following whatever the average gearing in the industry is. Whatever the average gearing in the industry is. Okay. Is there any FM-AFM revision session? Not at the moment. At the moment, there's just FM revision session. But having said that, most of the chapters of FM are also included in AFM, so you can at least watch FM, because that will, at least if nothing else, improve your foundation. Of course, the way the questions are asked are way different, but the base concepts are absolutely similar, or bare minimum FM concepts are there in AFM, so you can watch this one also. But at the point to answer your question, there is no AFM revision. Okay, coming back. So pecking order theory. Now this one is the next theory. So what all theories we've studied? First we studied the traditional view, then we studied Modigliani-Miller without taxation, then we studied Modigliani-Miller approach with taxation. Now we'll study the pecking order theory, which says there is no search for an optimal capital structure. Okay, effectively what happens is companies will say there is a hierarchy that we'll have to follow. What is the hierarchy? They will say we'll go for that source first which has the lowest transaction cost or lowest issues cost first. What are the lowest issue cost? We will say we'll first use the internal generated funds because they're already available. We discussed this yesterday. They're already available. Why will we borrow from elsewhere, or why will we raise new equity finance if we already have those funds? So you start with the internally generated funds, then you go for debt because debt is the next cheapest, and then you go for the equity. Okay, so the priority will be internally generated, then there is debt, then there is new issue of equity. First, why do you keep equity towards the end? Because there is no tax benefit, and these are also expensive. Debt before equity, because you get tax benefit, there is no dilution of ownership, and the issue costs are moderate, and there is no such problem in case of internally generated. So start with internally generated, then you go for debt, and then you go for new sources of equity. Okay, so this is effectively your pecking order. Now, Myers and Maslov also suggested there's an asymmetric information, which is an explanation for reliance on retained earnings. What do they say? The managers, because they have access to more information, know that the value of shares may actually be greater today. If it is greater, and then if new shares are issued, then that too at a low price, transferring wealth from the existing to new shareholders is what it will mean. Okay, new equity shares might also be sort of as the signal of bad news, and there is effectively some study also which said that has happened in the past. Whenever you issue new shares, that has happened. So effectively you will say, okay, I'll use my first internally generated funds, and only then I will go for new equity as a last resort, because whenever I go for new equity, my shareholders will think that there is a that we think that the price currently is going to be too high, as compared to what the ideal value is. So they will reduce the shares value. Okay, so raising equity conveys doubt. Announcement of new equity shares greeted by sharp stock price declines, and demonstrated equity issues are interpreted as bad news. So they say this is one more reason to say that you keep the new equity issues towards the end. Okay, is this clear, guys? Are you with me till here? Just put a thumbs up, yes, whatever. Just let me know if this is clear. We are almost nearing the end of this chapter, because the next topic is what we have already discussed. Sorry for the tech glitch. Assuming we are live again. Can you confirm if I am live? Just let me know. Okay, I'll wait for your thumbs up. Okay, I've gotten a yes, so I'm assuming I am live. Am I live and perfectly audible, visible? Perfect, sounds good. Okay, I'll keep moving ahead. Okay, so the next topic is what? The next topic says discount rate. Super, thanks a lot. So the next topic is, what is the discount rate that you use for the project appraisal? Now, part of it we already studied in the previous chapter, that you should keep using the WACC if your capital structure has not changed, your operating risk has not changed, which is your business line is the same as the business line which was there. Otherwise, the finance is not specific to that project, you are financing from a pool of funds, and finally the project is small in relation to the company, this or this. Okay, when is WACC inappropriate? A manufacturing company evaluating a software development. I had given another example yesterday. In these cases, what do? You use a risk adjusted discount rate. What do you do? How do you adjust the risk? We will take a proxy company. This we had studied yesterday. I'm just revising. Proxy company who is in that industry which you are trying to enter. Okay, so we will take the proxy company's beta of equity. Now, using proxies debt equity ratio, we will delever. How will we delever or unlever, however you might call it? The formula, we'll use the formula beta of equity is nothing but beta of asset into equity plus debt into 1 minus t upon e. So if you want to delever, you will just say beta of asset is equal to beta of equity multiplied by equity upon equity plus debt into 1 minus t. Okay, so if you want to unlever, this is the formula that you use. Okay, then what do you do? Now that you have got beta of asset, you will relever using your company's debt equity to find out beta of equity, and then you use this beta of equity in CAPM. Use it in CAPM. You know the equation of CAPM to find out what? The cost of equity. Okay, cost of equity. This we had discussed yesterday. All of this we've discussed yesterday. Types of beta. This one represents purely the systematic risk. This represents the systematic risk plus the financial risk as well. Remember, always for geared companies, beta of equity is greater than beta of asset. If your company does not have any debt, then the beta of asset and the beta of equity is absolutely the same. All of this we had discussed yesterday. This is the formula that I just told you about. Okay, When de-gearing, always remember, when de-gearing, you have to use the debt equity of the company of which you have taken the equity beta, which is the proxy company. When you re-gear from beta of asset to beta of equity, you will take the company, you will take off your company which is undertaking the project. This is a common error where people take the wrong debt equity, will take the wrong debt equity. Okay, is this clear? One more thing is, please note that if there is more than one proxy asset beta available, then you calculate a simple average. So let's say in my example yesterday, if your company, I forgot which company's example I gave, but let's say it wants to enter into pharma business. I think I said Reliance, I don't remember. But let's say if Reliance wants to get into pharma, what will it do? It will take Sun Pharma. But let's say it will take Sun Pharma also, it will take hypothetically Torrent Pharma also. Okay. I will take both betas. In your exam, don't worry, don't, this will not be tested, but I'm just telling you, if this were to be if this was to be mentioned, you will just take the average, you'll just take the average of the beta of asset. Okay, these steps you've discussed, you find out, first of all, you find out appropriate asset beta through unlevering, okay, through de-gearing, okay, then you adjust, you re-gear it with your debt equity ratio, you use the new debt equity ratio to find out the cost of equity. This we've already discussed right now as well as yesterday. Okay, and then this WACC or this cost of equity used to find out the WACC for this new business. Okay, now there's an example that is given. Let us take a look at the quick example. Omega, which is operating in the lift business, wants to evaluate a pharma project. It's beta. Omega's beta. Now Omega is an all equity. Omega is an all equity company, so it has no debt. Okay, it has no debt. It is 100% equity. The pharma company has a beta of equity of 1.75. It has a debt equity of 40/60. Correct. So what will you first do? You will de-gear. So you'll find out 1.75 into equity divided by equity plus debt. Equity is 60 divided by equity plus debt, so 60 divided by 60 plus 40 into 1 minus t. Tax is given as 30%, so 40 into 70% is 28. So you will be able to find out beta of asset at 1.19. Now this 1.19 is the beta of asset for the pharma business. You will now use to find out the beta of equity of Omega. If you had been given the beta of equity of Omega, you would have, or rather you would have been given the debt equity of Omega, you would have used that to calculate the beta of equity of Omega. But given it is 100% equity finance, the beta of asset and the beta of equity of Omega is the same. Okay, so 1.19 is the same. Now you use this in the CAPM equation, you find out the cost of equity for Omega, and this cost of equity you use over here. Okay, so your, which is, this is nothing but the WACC. This is now different from your original WACC. So when you evaluate the pharma project, you have to use 14.71, not your original 16.15. This could be a trick that they could test you in what, in case of a section A or a section B question, where they say which rate should you use to evaluate the pharma business, and the answer will be you should use 14.71. okay, there's another example which is given where you are said WACC calculate assuming no debt. So for each scenario you will see your beta of equity keeps increasing. In the scenario where it is all equity, this is your beta of asset. You calculated your beta of asset at 1.23. now if it was 30% debt, then your beta of equity will be higher. 50% debt, it will be even higher. You use this to calculate KE used to calculate WACC. Okay, I hope this part is clear. This is the summary of all the capital structure theories which are mentioned over here. This ends our chapter number 18, which is your capital structure theory. Any doubts over here? I'm going to pause for the next 1 minute. Any doubts over here? Please tell me. Feel free to ask if you have any doubts thus far. Is it clear fully? Is the full concept of de-gearing, re-gearing, calculating KE and calculating WACC, is this full concept clear? Guys, we have to move fast, so I've tried to not go into the full nth level of calculations, but I've tried to do justice to the topic as well, so I want to make sure that you are also understanding. Is it clear, guys? Let me know. I'm waiting for more responses. Okay, couple of you have said yes. Waiting for more. Super. Okay, so we'll keep moving ahead. Now, which chapter do you want me to start with next? Should I start with business valuation or should I go to risk management? I'm inclined to start with business valuation and keep risk management for later. By then you would have at least understood more chapters before I come to risk management. So I'm moving to business valuation next. Clear? Okay, someone has said risk management. I don't mind starting with risk management. Let us start with risk management. No worries. We'll start with risk management. Business valuation is anyway small. A good part of business valuation we've covered in the previous chapters, and don't worry, we'll still cover it today itself. But let us maybe, if you all want, we'll start with risk management. Which page number was it? Still 130. Yes. Cool. So let us get started with risk management, one of the very important topics from a Section C perspective that is going to be asked. And we start with Forex risk management first. So first of all, what is Forex risk, guys? What is Forex risk? Let's say you are a company, you are a UK company, you are an exporter, you have exported to the US, Now your goods that you exported were worth $1 million US. When you exported US dollars was 1.5, USD 1.5 was equal to 1 pound. Okay, so effectively, if you think about it, you exported worth 0.67 million pounds. Okay, now as an exporter, what are you afraid of? You have an asset in the foreign currency, you have a receivable in the foreign currency, you are afraid that the value of dollar will further depreciate. Let's say instead of 1.5 dollars per pound will now become $2 per pound. If this value becomes $2 per pound, then instead of getting 0.67 million, you will get $1 million divided by 2 per pound, which means you will get 0.5 million pound. So despite the fact that nothing else materially actually changed, your receivable actually reduced from 0.67 million pounds to 0.5 million pounds. Why did this happen? Because of the change in foreign exchange rate. This is called transaction risk, which is on the date that you have done the transaction and on the date of payment, if there is a gap, during that gap, if there is the foreign exchange rate that changes, because of that, what might happen is there might be a risk. There could be an adverse outflow, or rather adverse outflow, basically adverse effect, or there could be a positive effect also. So this happens to only companies, not necessarily only companies that engage in international trade, but definitely those companies that are engaging in international trade, especially in a floating rate exchange rate system where the exchange rates keep changing continuously, which create us uncertainty about the future transaction values. What happens when the depreciation happens of a currency? So let's say over here the USD depreciated. Earlier they had to give only $1.5 for every pound. Now they have to give $2, which is they have to give more dollars because the value of dollars reduced. Then what happens? If it was a receipt, then there was a adverse movement. But now if dollar would have strengthened, then the receipt would have been favorable. If it would have strengthened from 1.5 to 1.25, then you would have received, as a UK exporter, you would have received 0.8 million pounds, which is nothing but $1 million divided by $1.25 per pound. I hope this is clear. I hope this is helpful. And of course, the reverse position will happen in case of a payable. There are primarily three exchange rate systems. There is a fixed exchange rate system, which is where a currency is pegged to another currency requiring central bank intervention. There is a freely floating, clean float exchange rate system where market demand and supply, and most of the countries today follow a floating exchange rate system where market demand and supply determine the exchange rate. And third is a managed floating system, which is also called as a dirty float, where it is determined by the market forces, but the central bank has to intervene. In India also, if you see, the RBI does intervene at certain points in time if the rupee keeps depreciating continuously. Okay, There are three types of foreign exchange risk, and this could be a theory question that could also be asked. Three types of foreign exchange risk. Number one risk is a transaction risk. Transaction risk is what? The example that I gave you. This is an example of a transaction risk, which is it can happen in case of import-export transactions, foreign loans and deposit, or investment. This is a short-term risk. This is a short-term risk, and this is a cash risk, which means between the transaction date and the settlement date, if the exchange rate changes, then this is what happens. Second example I could give is of an economic risk. Let me give you an example of an economic risk. Let's say you are an exporter. Let's say you are an exporter. You used to sell. Let's say you used to sell. You are an Indian exporter. You are an Indian exporter. Okay. You are selling textiles to the US. Okay. Let's assume today rupee is 90 per dollar. Today is rupee 90 per dollar. Okay. You sell goods worth rupees 9,000. You sell goods worth rupees 9,000 to US. Okay, which means in terms of dollars it is $100. For the US customer it is $100. Tomorrow if the exchange rate increases to 100 rupees per dollar, your goods stay 9,000 rupees only, but then in dollars now your customer has to pay only 90. Your customer has to pay only 90. So this 100 has become 90 without you actually changing the price of your goods. The 100 suddenly has become 90. It has become cheaper for your customer. Why? Because your home currency depreciated. On the other hand, if your home currency had appreciated, it would have been a loss to the exporter. But think of the same logic from an importer perspective. From an importer perspective, was importing $100 goods, good. Earlier he was paying 9,000. The $100 have remained $100 from an importer perspective, but this 9,000 has now become 10,000 rupees. So for an importer it has become expensive. The fact that the home currency has depreciated, the imports have become more expensive. So if your home currency strengthens, then exports become more expensive, correct, which is the reverse example of this. And if your competitors currency weakens, their exports become cheaper. So let's say in this example, let's say if I give an example of Bangladesh, let's say your currency has not changed. Let's say Bangladesh also supplies to the US. Now I don't know what their exchange rate is. I'm making it up. Let's say their exchange rate is they have to give 150 per dollar. They have to give Bangladeshi rupiah 150 Bangladeshi rupiah for a dollar. Okay, I don't know what their exact exchange rate is. Now they were thus far selling at, for example, let's say they were thus far selling at 18,000 Bangladeshi rupiah. Okay, so 18,000 Bangladeshi rupiah means effectively if you convert it divided by 150, it means $120. Now suddenly their currency exchange rate has worsened. Their currency exchange rate has worsened to 200 per dollars. Their currency exchange rate has worsened to 200 per dollars. What this means is now 200, or let's say 220. Okay, whatever. Now, despite the fact that they are selling at 18,000, from a US guy perspective, now they'll be able to buy at $82. See, earlier what used to happen is, hello Vishal sir, good to see you. Earlier what happened is your good was cheaper. You were selling at $100, which was cheaper than the Bangladeshi exporter who was selling at $120. But because now the Bangladeshi currency has depreciated, the Bangladeshi goods are available at $82. Despite the fact that Indian exchange rate has not changed, the Bangladeshi goods have become cheaper. This is not your fault. The fact that the competitor's currency has weakened, their exports have become cheaper, which means you as an Indian will lose the market share despite any fault of yours. This is unfortunately the problem. Okay, so this is what an example of economic risk is. Now, how do you manage economic risk? There's no direct way of managing. There is no hedging that you can do. The only way you can do this is by diversifying your markets, which is you have presence across multiple markets so that you are overall able to manage your risk. You have diversity of production locations. You have diversity of suppliers. You have diversity of financing across countries and currencies so that you're able to diversify your risk. The third risk, which is a translation risk, is effectively only a paper risk. It is a long-term risk and it is a paper risk, which means if if a company, if a UK company had invested in a US subsidiary, when it had invested at $1.6 per pound, so it had invested 1.25 million, but now suddenly the dollar has depreciated to $2, which means the currency, now the assets value has automatically reduced because US dollar has depreciated. The value of the subsidiary's assets has reduced from 1.25 to $1 million, and hence there is a paper loss. Is this an actual loss? No, the actual assets are kept. The factory is kept as the way it is in the US, right? But this is a paper loss when you actually make financial statements that Vishal sir would have taught you in FR, right? When you actually sit and make the financial statements, there will be a translation loss because the dollar has depreciated versus the pound. So this is just a paper based exercise. There is no actual cash flow. This only affects a reported performance, not the actual performance. But the share price may react only if it actually reflects your real world constraints also. For example, if it affects a breach of a loan covenant, otherwise it will not affect the share price generally. It will not affect the share price because it is non-cash in nature, and hence this is generally not hedged because there is no real cash flow impact. Are all the three types of exchange rate risks clear? Transaction risk, translation risk, and economic risk. Remember, the actual cash flow risk plus a short-term risk is only transaction risk. So if you want to hedge, you will hedge only transaction risk. Now, if I was to make this matrix, right, whether short-term or long-term, okay, short-term or long-term, or let me put it this way: short-term or long-term, cash flow affected or not. Okay, and third one will be whether actual or paper. Now you see transaction, economic, translation. Okay, transaction risk is a short-term risk, cash flow risk, and it is an actual risk. Economic risk is a long-term risk. It is also going to affect your cash flows, right? And it is also an actual risk, but it is a long-term risk. Translation risk could be short-term or long-term, could be both short-term and long-term, but it does not affect cash flows, and it is a paper-based risk. Okay, I hope this is clear. There could be a section EB question or there could be a theory, so you should be able to explain what each of these three mean. You can also now use examples. Now, there could be two ways how you would quote a particular currency. Okay, one is you say $1.5 per pound. Now, assuming you are a UK company, your home currency is pounds, and your counter currency, which is your foreign currency, effectively foreign currency, is dollars, correct? So there could be two ways how this could be quoted. The same quotation could be 1.5 per pound, or it could be 1.67 pounds per dollar. So the number of, let's say if you have gone to the market and you are saying you want to buy a chocolate, okay, you will say one chocolate costs £1, hypothetically. I don't know if that is expensive in the London, maybe it is. So let's say one chocolate costs £1, or let's say if it costs 1.5 pound for the sake of simplicity. How many units of your home currency do you have to shell out to buy a unit of chocolate? Similarly, think of it as dollar being the commodity here. How many units of your currency do you have to shell out? This is nothing but a direct quote. How many units of your home currency do you have to shell out? When it comes to how many units of a foreign currency do you have to shell out, it comes to an indirect quote. How many units of the foreign currency do you have to shell out to get 1 unit of your home currency? This is your foreign quote. Okay, so now in an equation like this, what does it mean? It means that this currency, now let's say 1.5 per pound is the base currency. This is called as the base currency. Whatever is in the denominator is the base currency. Okay, and whatever is in the numerator is the counter currency. Clear? Counter currency, which is in the numerator. Okay, I hope this is clear. Now I'm going to give you three logics. Now this is where a lot of students actually make a mistake. So I'm going to give you three logics to get this right. When in examination, you are going to get a quote like this. Now, first of all, what does this quote mean? This means that the difference between 20 and 30 is the margin of the bank. because bank has to earn profit. If it is exchanging the currency for you, it will definitely earn a profit from you, right? So I'm going to give you three logics to decide if you have to use the quote, which do you use the left hand side or do you use the right hand side? Okay, number one, I'm going to give you a memory technique. I will give you the logic, but before that I will give you the memory technique. You have to remember that bank always sells low and buys high. Sells low, buys high. But what? Sells the counter currency low, sells the counter currency. In this case, what are the counter currency? Counter currency was dollars. So if the quote was 1.5250 and 1.5260, sells low. So if the bank has to sell dollars, which means you are buying the dollars, then you will use the left hand side, you will use the low. But if the bank is buying the dollar from you, then it will give you this particular rate. Okay, if you are a UK exporter, which means what? You will receive dollars. If you are a UK exporter, you will receive dollars, and then when you receive the dollars, what do? You sell dollars to the bank. When you sell dollars to the bank, what does the bank do? The bank will buy the dollars from you. This is bank buys dollars. If the bank buys the dollars from you, bank will always buy high. Sell low, buy high. So you have to use the right hand side rate, buy high. You remember the acronym, sells low, which is hello, and buys high, you can assume buy. Okay, so if you are having a receipt, you will use the right hand side rate over here. If you have a receipt, the bank will say, I will buy dollars from you. You will sell the dollars to the bank will buy the dollars from you at a higher price, which is this. So that's logic number one. Logic number two, if you want to remember, keep noting this down. I won't be able to write all of this over here. Logic number two is, if it is an indirect quote, this is an indirect quote because you are a UK exporter. So for you, UK is the home currency. So in case of this quote, right? In case of this quote, this is an indirect quote. So in case of, remember this is only applicable in case of indirect quotes. If you want to receipt, use right hand side. So receipt, use the right hand side rate, you will use this rate. Receipt, use the right hand side rate. And payment will be left. Payment will be the left hand side rate. That is the second logic that I'm giving you. Remember guys, is one point where everyone makes mistake. So I'm giving you three logics to remember this. Kindly, if you don't want to write right now, later on you can watch the recording, you can note it down. This will really help you in the examination. So that is the second logic that I'm giving you. Now I will give you the third logic. Guys, always when bank is paying you money, bank will pay you lesser money. But when you are paying money to the bank, you will always have to pay higher. So let me explain. Let's say in this case, you had to pay $1 million. You had to pay $1 million. Okay, $1 million. Now you will do what? You will divide, and also should you divide or you should multiply? If it is $1.5 per pound, what should you do? If you have to pay dollars, what do? You divide or do you multiply? Remember, you have to come to pounds. Right? You have to come to pounds. Now you have to pay 1 million. So I will say 1 million. I have to do what? I will have to do a mathematical equation which will effectively cancel out dollars and which will keep pounds. So I will say into pounds by dollars. If I keep such an equation, only then dollars will cancel. But what I have is $1.5 per pound. So what will I say? I will say 1 divided by 1.5. Correct? Which is effectively me dividing. Correct? So 1 million divided by 1.5. Only if I do this will dollars cancel each other out. And I will have what I need, which is the pounds. And now I can of course multiply 1 into 1 divided by 1.5. So always when you are confused whether to divide or to multiply, you have to always think what is the mathematical equation which will help me cancel out these, Okay. Now over here, if I have to pay $1 million, in an indirect quote, so I will have to divide. So what will I say? I will say 1 million. What did I tell you? I told you that if you have to pay $1 million, so now pay. So pay should be the left hand side rate. Okay. So 1 million should be the left hand side rate, 1.4420. 1 million, which is 6 zeros, divide by 1.4420. How many pounds do you have to pay? You have to pay 693,481 pounds. This is the number of pounds that you have to pay, correct? Now, if I was to use the other rate, then I would have used 1.4430. If I use 1 million divided by 1.4430, what number does it come to? It comes to 693,000. 693,000. Which of these is a bigger number? This is a bigger number. Remember, what did I say? When you have to pay, you have to always pay higher. If you have to pay, you will always pay this number, but when you have to receive, you will always receive the lower number. Lower number is this. So receive is the lower number, which can come using the right hand side rate. If you have to pay, you will pay higher, which will come using the left hand side rate. So even if you forget all the rules in the examination, always remember that when you have to pay to the bank will always say you have to pay me higher, but when the bank has to pay you, the bank will always pay you lower. Is all of this clear? Why don't I write it down for you? Let me write some of these for you. You have to tell me if all of this is clear or if you have any doubt, because this is one source of doubts for all of you. I'll also write it down because this is an important topic. I'm waiting for you to put your point in the chat box if this is clear or if you still have any doubt. Sorry, 1 second. Is it clear? Mathematically it is super easy. If you have to pay $1 million, you will say $1 million into pound by dollar. If you have been given pound by dollar rate in the question, you will simply multiply. But if you would have been given dollar by pound equation, you would have divided and you would have been able to come to the same answer. Okay, always check mathematically what is going to make sense. So whether you divide or multiply, you check this. Number three, whether you use bid rate or ask rate. Bid, ask. What is bid? Bid is the left hand side rate, ask is the right hand side rate. So bid is equal to left. Sorry, this is not left, apologies. And ask is equal to right. Correct? Ask is right. Correct? Ask is equal to right. Now what do? You will say, first logic that I gave you, first logic was what? Bank sells counter currency. This is always for counter currency. Bank sells counter currency, which in our example is dollar, low. Bank sells low and bank buys high. Buys what? Buys counter currency, which is in our example dollar high. Clear? This is one logic. Number two, if it is an indirect quote, if this is an, guys, this is important and hence I'm spending so much time on this. Otherwise I could have just said this and moved ahead, but I think this, I want to write this so that you write this. If indirect quote, quote unquote, this has to be an indirect quote, then RR and LP. What is RR? What is RR? Receive right, pay left. Pay left. So I could say PL. Okay, RR and PL. And number three, you always pay more and you always receive less. I'm giving you three logics, whichever you like, you keep that logic. You want to check the logic in the examination, you can use all three. You always pay more and receive less so that bank can keep the margin. Okay, keeps margin. Now are all the three clear? Is one source of confusion for everyone. Should I divide or multiply? Should I use the bid rate or ask rate? Now I hope with all this logic it is clear for you all. I want you all to put a yes, or even if it is a no, it's okay. Please put it so that I know if I'm going in the right direction or not. I want you to put it in the chat box. I'll wait for 30 seconds. So someone has said it is now clear mathematically, otherwise there was confusion. So I'm glad. Someone else has also said yes. Is it clear for the rest of you? Please let me know. All clear? Thanks Richi, thanks Pavesh, thanks Pooja. Super. I will now move ahead. Now, the balance of payments effectively is what? It is the current account deficit, which is where imports are greater than exports. Where imports are greater than exports, then what happens? There is a current account deficit and your currency depreciates. So capital flows often dominate trade flows because of interest rate. People will decide where to invest. Wherever the interest rates are attractive, people invest there. Inflation will decide what currency appreciates or depreciates, and political stability also decides. So if there is a country or a currency where there is instability of political environment, then the currency will depreciate. Now the purchasing power parity theory says, that if that the exchange rates have to be moved in such a manner that the relative inflation rates get offset. So for example, if rupee 1 is equal to 90 today. Rupee 1 is 90 today. Okay, $1 is equal to 90 rupees today. Okay. Now let's say a pizza is $4 in the US and it is 360 rupees in India. Let's say hypothetically. Now if for example hypothetically the Indian price, the Indian price was to increase to 400 rupees, and the dollar price was to not increase, or let's say the dollar price was to increase hypothetically to say $5, and the Indian price was to increase to say, for the same pizza, was to increase to say 500. Then what happens? Now the exchange rates will automatically adjust itself. Sorry, not this, maybe not example. Yes, 450. So let's say Indian price moves to 450 and the dollar price moves to 5. So the currency exchange rates will automatically move. Actually, the previous number was better. Automatically move that now the exchange rate will become 100 to compensate for the relatively different inflation. What happened in India? The price moved 360 to 500. So there's a higher inflation in India than there is in US. So your exchange rate of India will depreciate. So any currency which has a higher inflation will depreciate. What is the formula? It says the expected future spot rate. The expected future spot rate is nothing but the current spot rate of the currency multiplied by the inflation rate of the counter currency. Remember guys, this is HC. Okay, divided by the 1 plus inflation rate of the base currency of the base currency. And always remember, the rule is that the country with a higher inflation will always see its currency depreciate. Always remember this rule, guys. There's an example where this is an indirect quote, but doesn't matter, chuck it. Let's say we say $1.8 per pound, then dollars is the counter currency and pound is the base currency, correct? So you will say pound inflation should come in the denominator and US inflation should come in the numerator. 1.04 divided by 1.02 multiplied by today's exchange rate 1.80. And who has a higher exchange rate? US had a higher exchange rate. So what happens now? You will say the currency of US will depreciate. They will have to pay more dollars to receive the same number of pounds, okay, which is for 1 pound you'll have to pay a higher number of dollars. I hope this is clear. But remember, there could be one place where they could trick you. One place where they could trick you is they could say, what if you have to calculate? What if you have to calculate for 2 years? You have to calculate the expected exchange rate at the end of second year. Then what do? You will simply put a square. If they would have said, okay, we will have to calculate for 6 months, then what do? You will say in the same example, if you have to calculate for 6 months, what will you do? You will say, or let's say for 3 months hypothetically, to avoid confusion, for 3 months you would have said US 3-month interest rates would be what? 4 into 3 by 12, so 1% for 3 months. 1% for 3 months. UK would be what for 3 months? UK would be 0.5% for 3 months. Okay, UK would be 0.5% for 3 months, and then you would say 1.8 into 1.01 divided by 1.005. okay, this is how you would do it. So be very careful what is the time period that is given in the examination. Okay, limitations of purchasing power parity theory is future inflation estimates are always uncertain. It is not necessary that always the inflation rate will, or I would say the exchange rate, move in the exact same direction as the inflation rate. Plus there could be some non-tradable goods also which are not reflected in the exchange rates. There could be speculative transactions which also dominate the market, and actually 98% of the transactions are actually speculative and not trade related. Plus better from long-term predictions rather than short-term. In short-term, it's not necessary that exchange rates will reflect the difference in the inflation rates. The interest rate parity theory is quite similar, except that it says the forward rate. Now what do we mean by forward rate? The rate for today. So if I say the forward rate today for a year hence, so what is the rate today that I expect to happen in a year from now will be reflected. The logic is absolutely the same as the inflation rate, except that I will say there is, instead of inflation rate, here we use the interest rates. Otherwise I would say if India gives 10% on savings deposit, in India gives 10% hypothetically, and US the interest rate is only 5%, I will always borrow from the US and invest in India. Without doing anything, I will borrow from US and invest in India. So they are saying no, that is not possible, because Indian currency will depreciate to the extent of the difference between the interest differential. So the formula is the same, 1 S0 into 1 plus IC. IC over here is interest of the counter currency. So in our example, US UK, US is the counter currency, that will be in the numerator, and UK is the home currency, that will be in the denominator. Let's look at another example. Again the same logic as inflation rates, the same logic. The currency with the higher interest rates will always trade at a forward discount. Will effectively, what does it mean? It will always depreciate. Okay, will always depreciate. Now let's say if the Swiss francs per euro is 1.2, which of these is a stronger currency? At this point euro is a stronger currency, because you need more Swiss francs for per unit of euro, correct? Now however, the issue is the interest rates of euro are higher, which means which currency should depreciate? Euro should depreciate. Guys, whenever you put the answer, you should be able to sense check logically that the currency that has a higher interest rate will depreciate. So if you see now, Swiss francs in numerator, euro in the denominator, it has reduced from 1.2 to 1.17, which means now you have to give lesser Swiss francs than you used to have to give. Why? Because Swiss francs has appreciated and euro has depreciated. Okay, so euro, which had a higher interest rate, will now trade at a forward discount against the Swiss franc. You will say, oh, but 1.2 actually went to 1.17 Swiss francs. So you will say, oh, but Swiss francs has discounted. No, it has not discounted, it has strengthened. Why? Because you have to give lower Swiss francs to get 1 unit of euro, which means now the value of Swiss francs has actually improved. This is how you have to think mentally. I am also training you on how to think mentally in the examination when you are stuck. This is how you have to train mentally. Same logic, calculate forward rate for 3 months into 3 by 12 into 3 by 12. If it is for 18 months, into 18 by 12, 18 by 12. Okay, I hope this is clear. Crucial note, in the real world and in exam scenarios, Banks calculate the forward rate using IRPT. Therefore, the forward rate quoted by banks is nothing but the IRPT quoted. IRPT is what? Interest rate parity theory quoted forward rate, which is usually identical. This is why money market hedges typically give the similar outcomes to forward contracts. If they differ slightly in the examination, it is only because of the rounding of differences. Understanding this connection helps the relationship between section 7, 10, 11 will come when it comes to that. Okay. Effectively, what they are trying to say, if they are trying to say, this is the Fisher equation. Remember, this is the Berger equation we had studied yesterday. They are saying there's a four-way equivalence theory, which is what this is the purchasing power parity theory, this is the interest rate parity theory. So they are saying effectively the expectation theory, and this is an important point from an MCQ perspective, could be asked. Expectation theory says that the difference between forward and spot rates, which is F0 upon S0, is equal to the difference between the equivalent change in the spot rates S1 divided by S0. So they have equated this equation. They have just equated the purchasing parity theory and the IRPT equation. They have said F0 by S0. What is F? F is the forward rate for the time period but quoted today. S1 is what? S1 is the expected spot rate. So forward rate effectively represents the expected spot rate, okay, of that time period. And you know, H stands for inflation, I stands for interest rate. The key insight for you guys is what? If a currency has a higher inflation, it will always have a higher nominal interest rate. This is the Fisher effect. Okay, higher inflation, or you can say purchasing power parity theory also. Okay, which is currency will expect it to depreciate, and if it has a higher interest rate, then it will be again trading at a forward discount, which is nothing but it will expect it to be depreciated. In equilibrium, forward rate should be equal to the expected spot rate, which is nothing but the expectation theory. Okay, is it clear till here, guys? Is it clear till here? Please let me know. Is it clear till here? And we'll now quickly move to, so this was all about the basics of what foreign exchange risk means, what are the different types of foreign exchange risk, what does exchange rate mean, how do you determine the future exchange rate, or typically how does that move. Now we'll come to how do you effectively manage the foreign exchange risk in the exam and in reality. How do you manage the foreign exchange risk? That is the next topic that I will go to. Okay, let us quickly move to the next topic. But first of all, give me a thumbs up, yes, whatever works in the chat box, that you've understood whatever it is thus far. If there is any doubt also, please mention it in the chat box. And then I will move ahead. Okay. Now, the next topic is practical approaches to manage foreign exchange risk. First of all, these are the easier approaches, right? This is without using any hedging instruments. So the first approach is, instead of invoicing in the foreign currency, invest in the home currency itself, because even if there is no foreign exchange, when there is no foreign exchange differential involved, if you are invoicing in the home currency, the foreign exchange risk is of the buyer. It is not your risk at all. Why do you have to take a risk? No, you don't have to take a risk. But in reality, it is not possible. The buyer will say, why should you invoice in your currency? You invoice in my currency, you take the risk. Second is a do nothing approach. Why? You will say you take the risk, it's a smaller risk, it's okay, no problem. So it's a smaller transaction, it's okay. Next is the leading lagging. For example, in my example, if you have to pay, if you are an importer, you have to pay, instead of paying 3 months later and being exposed to the foreign exchange risk, you will say I pay today only. I will pay today only, and I will try to take lesser risk. I will pay today only, which means leading. But when you know that you have to pay, and that currency where you have to pay is expected to appreciate, which means in home currency you'll have to pay lesser, so you'll lag the payment. But in reality, do you think, see, if you pay early, people will be okay. But if you pay late, will people be okay? And similarly, if you have a receivable, can you ask your customer to pay early? If he had to pay early at the first place, he would have not taken the credit risk. So theoretically this is fine, but in reality this is not possible. Okay, there's an example also given, but this again speculation. On what basis do you say that you expect the dollar to appreciate or depreciate? This is only speculation. Next is matching receipts and payments, which is, if you have a foreign exchange payment but you also have a foreign exchange receipt, so what do? You will say I will offset and only the net amount I will bring back. Okay, so I have to receive 2.4 million, I have to pay 1.8 million, so the net exposure is 600,000, so I will only hedge 600,000. This helps me save the transaction cost. Okay, netting, which is if you have intercompany balances, right? If you are a company which has a lot of subsidiaries, you will net all of these, net all the payments and receipts, and you will be able to transfer only whatever is the net due to the respective currency. It's like Splitwise. For all those of you, I don't know how many of you know about Splitwise, but Splitwise is an app which helps you make payments or receipts or put expenses divided between all your friends. So what does splitwise do? Splitwise will adjust all the net receivable payable and it will say this is the net amount now you have to pay. So netting is like splitwise. I myself had never thought about this before. It just came to my mind right now. Okay. So foreign exchange bank accounts, you will say if I frequently am a UK company who frequently trades in dollars, have a bank account there only, so that you make all payments from there, you have all the receipts from there only, and finally you match your foreign exchange assets and liabilities. For example, if you have a US subsidiary, finance it using a US dollar loan, so you that exactly you can offset whatever your currency movements are. Okay, is this clear, guys? Is this clear? Please let me know if this is clear. And we'll take a short 5-minute break now before we move to the concepts of the forward exchange, money market hedge, futures and options. We'll take a short 5-minute break. I'll just wait for you guys to say you understood or not, as the case may be, and then we'll take a very short 5-minute break. Any doubts, guys? Or else we'll take a 5-minute break, or maybe we take a break. If you have any doubts, you can put it in the chat box. We'll take a 5-minute break and we'll be back in 5 minutes. See you. back, everyone. Was a slightly longer break, but I think you will be braced up for what is next. I hope that break was helpful. Let us quickly move to forward exchange contracts. What are forward exchange contracts? Basically, it is a type of a contract which you enter into with a bank, and you say that this is basically I'm getting into an agreement with you. This is the amount of foreign exchange that I am yet to that I'm to receive in a few months, or that I'm to pay in a few months, and I am wanting to fix the exchange rate with you today itself. So it is an agreement to buy or sell the currency at a rate which is agreed today itself. So there's an example which is given, and this is of course at a forward rate which will be different from the rate that is quoted today. So for example, if you have to receive 1.5 million, the forward rate is 1.53. You will receive this amount, which is certain irrespective of whatever rate happens in the market. You do not care. You will say this is the rate that we receive at that, and similarly payment as well. So the advantage is it is certain, it is customizable, it is simple. But on disadvantages, once you've entered into the agreement, you'll have to have binding agreement. Even if the exchange rate now you moves in a direction which you could have benefited of and moves in your direction, you'll have to still honor the contract. Okay. Now moving to the money market hedge. What happens in the money market hedge? You simply say if I am a UK exporter, and I had to receive US dollars, if I have to receive US dollars, what will I do? I have an asset in the foreign currency. What will I do? I will create a liability in the foreign currency. How do I create a liability? I will say I will borrow in dollars. Why? I will borrow in dollars so that when I receive the payment from my customer, I pay the liability. This is important. If you get confused whether you should borrow or not, then what should you do? The amount that you have borrowed, you'll have to bring it back. Basically, what are you saying? If I would have waited till the time that I receive, I would have received, let's say, in 3 months from now. Instead of that, I will receive the currency today only. If you want to receive the currency today, how will you receive? You will say, I have borrowed the currency from a bank over there, and I will repay the bank when I receive the money from the customer. So what will I do? I will borrow today. I will convert it to today's spot rate. Convert it at today's spot rate, not a forward rate. Today's spot rate. Bid rate or ask rate, the same logic as I had given earlier. If you want to receive, you will use the right hand side rate, which is the ask rate. If you want to pay, you will use the left hand side rate. And the amount that you have received now, you will deposit in your home currency. Till the time the customer makes payment. Now what happens? You will say, I will compare the actual receipt, including the interest on this deposit, with what would I have received from forward contract, with what I would have received from the forward contract. Okay. Now, the nuance here is that what amount do you want to borrow? Let's say if your receivable was 1 million, what is the amount that you borrow? If your receivable was 1 million, you will borrow the present value of this 1 million. So let's say if you receive 1 million in 3 months from now, then what do you do? What is the present value? Let's say what is the US borrowing rate? What is the dollar borrowing rate? Let's say in the question, if they have given the dollar borrowing rate at 6%, you will say 1 million divided by 1 plus 6% into 3 months, so 3 by 12. So which means 1 million divided $1 million divided by 1 plus 0.015. Is this clear? 6% into 3 by 12 is 0.015. So this is the amount that you will borrow. Once you've borrowed, you will convert at spot, you will deposit. And what is the amount that you will get in 3 months? The 3 months forward amount will be effectively your base amount plus interest that you will earn in UK, on that amount for 3 months. Okay, for 3 months. How do you remember if you have to borrow or deposit? Always remember that you have to receive. If you have to receive, then your memory aid is busy depositing. Basically, You have to first borrow, then sell, then deposit. This is the memory aid, which is if you have to receive, receipt, busy depositing. So borrow, sell, deposit. But I'm saying, guys, see, I keep giving memory aids because that's my duty as a faculty and you can remember. But honestly, I will give you the simplest logic, which is what? If you have an asset in the foreign currency, which is a receipt, then you create a liability. How do you create a liability? By borrowing. If you have a liability in the foreign currency, which is if you have to make a payment, you create an asset in the foreign currency. How do you create an asset? You basically deposit. Same logic, present value, foreign deposit rate. Okay, in that scenario, it is a foreign borrowing rate, here it will be foreign deposit rate. You convert at the spot rate. What should be the spot rate? Payment left. Okay, then borrow and then convert it into the 3-month forward amount. How do you convert that? You basically say I will add the borrowing rate of the home currency. So if again saying if you had a liability in a foreign currency, you will create an asset through depositing, and if you had an asset in the foreign currency, which is a receipt, you will create a liability through borrowing. Okay, I hope this is clear. An example is given, but you can take a look at the example. Basically, they are saying you have to receive, UK company has to receive in euros, okay, 960,000. You have been given euro, so basically you have to receive. It's an asset, so you will borrow to create a liability. So you'll use the euro borrowing 5.2%. They've used 5.2%. They've created the present value, which is 947,000. Now they'll sell it at spot. Correct. They will sell the foreign currency at spot, which means the bank will buy the foreign currency at a higher rate. Bank buys high, so it will be at a higher rate. Higher rate over here is what? Higher rate. Now remember, you have to use spot rate, not forward rate. Spot rate is 1.67, so you'll use 1.67. This is the amount of pounds. You'll have to deposit the pounds now in your home currency at the pound deposit rate, which is 5.5%. Always remember, the deposit rates are always lower, the borrowing rates are always higher, and then you will be able to compute the value 3 months hence. Then now you have to compare this value with the forward rate, and then you say you will choose that option which gives you a higher amount. When you have to receive, you will choose that option that gives you a higher amount between 823,000 and 817,000. 823,000 is better, and hence you choose money market hedge. But when you have to pay, you will choose the amount which has the lower cash outflow, okay. I hope this is clear. And guys, one thing always remember, in the question they might tell you have to receive so much and you have to pay so much. Always net it off first, and then use your forward rate and money market rate. It is quite a possible question where you are given a payment, a receipt. You will net it off, then you will use the forward and the money market rate, and then you'll be comparing the two, and you will say if I have to receive, then I have to use the one which gives me a higher amount. In this example, forward is giving the higher amount. If I have to pay, I will choose the one that is giving me the lower amount. Okay, I hope this is clear. Now quickly moving to foreign market or rather foreign currency derivatives. But until now, is this clear? Are both forward rates and money market rates clear, guys? Please let me know on the chat box. Are both the forward rate as well as money market rates clear, guys? Please let me know. Are both of these clear, guys? Please let me know. I will wait before I start the currency futures. And I hope this lecture is helpful. I hope, hi Vruddhi, good to see you back. I hope this is enabling you to clear your concepts. I'm not sure if they are clear earlier, but I'm hoping this is helpful. I see a lot of yeses. I will move ahead. So currency futures are what? They are basically traded on the stock exchange. Forward contracts, they are similar to forward contracts, but the only difference is what? The only difference is that the future contracts are traded on the stock exchange. The forward contracts were standardized, were customized contracts through the bank. Future contracts are standardized, which are traded on the stock exchange, and they have margin requirements. Okay, the same logic, which is what? Effectively, if you have to receive, right, you have to receive. What do you do if you have to receive? And the contracts are, there are pound contracts. You have to receive what is there in the question. There are pound contracts, for example, right, and you have to receive pound. There are pound contracts and you have to receive pound. Then what do you do when you have to receive? When you will receive pound, let's say you are a US company. Now let's say you are a US company. Let's say in this scenario you are a US company. Now in the US company, you have to receive pounds. Right? Then when you receive pounds, you will sell pounds to get dollars. So you will sell pounds, and if you have pound contracts, which means you will sell pound contracts. You will sell pound contracts. Okay, you will sell pound contracts. Future scenarios also, what happens? Remember, always remember, in case of futures and options, the actual transaction is a different transaction, and your future option transaction is a different transaction. These are two different transactions. Always remember. So one transaction is where you actually receive. One transaction is where you actually receive at the relevant spot rate on the date of the settlement, and the other transaction is which talks about the future profit or loss. So you had sold at 1.82, but actually the rate moved up to 1.88. So because the rate moved up, now you get more dollars. But on the other hand, because you had locked your rate, you will be making a loss on futures. Because your rate was locked at 1.2, your net amount always has to be the rate at which you had locked the futures. But this is two separate transactions. Always remember, this is two separate transactions. Okay. In case of options, options are very similar to future, except that there is a right, not an obligation. It gives you a right to buy or to sell a particular currency at a future date. The right to buy is called call. The right to sell is called put at a predetermined rate, because they give you a flexibility. Because they give you a flexibility of whether you exercise the option or not. As the name suggests, it's an option. Because it gives you the flexibility to exercise the option, you have to pay a premium. There is a cost for that flexibility, which is the premium. Okay, but having said that, you will exercise only if the rate is moving in your favor. Otherwise you will not exercise, you will let the option lapse. Okay, let us look at an example. A UK company is set to receive $3 million in 3 months. Okay, it's a UK company and it has a receivable in the foreign currency. You have a current spot rate, you have an exercise rate. Okay, what will you do? There's an option on sterling, which means when you receive dollars, what would you have done? You would have sold dollars. And you would have bought pound. If you want to buy pound and the options are in pounds, if the options were in dollars, you would have bought a put. If the options were in dollars, you would have bought a put, but given the options are in pounds and you will buy the pound eventually when you sell the dollars, you will say, I will buy the call option. I will buy the call option on sterling. Okay, I'll buy the call option on sterling, which is at 1.55. Now what happens? Let's assume two scenarios. If the rate moves to 1.65, which is dollar weakens, your receivable was in dollars and the dollar weakens, unfortunately so. But you had already hedged yourself at 1.55, so you will exercise the option. Why? And how do you decide if you want to exercise or not? You will always exercise if you are in gain. You will never exercise if you are in loss. How do you check if you are in gain or you are not? If you divide the dollars by 1.55, you would have gotten 1,935,484. Okay, 1,935,484. But if you would have gone for the market value, which is 1.65, so 3 million divided by 1.65, you would have gotten in pounds, you would have gotten 1818182. You have gotten this number, which is higher in pounds. This is higher in pounds, so you will exercise the call option. Okay, but loss, you will anyways have to pay premium, so your net proceeds will be this. But when you divide it by a lower number, always remember, when you divide by a smaller number, it will give you the higher net proceeds. If the dollar has strengthened, if your receipt has actually strengthened, then you will say, I don't want to exercise the option because my market value is actually higher than my option value. So I will lapse the option and I will go for the market value. I will lapse the option. So my actual receipt will be 2027 minus the premium. So I will get a net benefit of 2005027. Okay, I hope this is clear. I'm telling you one more thing also, you might be conceptually clear when you are listening to me, but I will suggest you one very clear thing, especially when it comes to futures and options, guys. Please, it comes to the entire chapters also, please do read all the chapters when you go home, or rather when you are not watching, you are already at home, when you're not watching this video, do read it at your end. But especially futures and option, try to read it with a calm mind. Try to read this example also with a calm mind. You'll be able to understand. Right now I'm not able to devote a lot of time to this at this point because you have to move ahead also. Okay, now when do you use forward, when do you use option? When the transaction is certain, when no flexibility is needed, when you don't want any upfront cost, when you don't want any risk, you will go for forwards. When the transaction is uncertain, so you want an option. When you want upside, and you can take the risk, When you're willing to pay the premium, you go for options. Okay, otherwise you go for forwards. Okay, now these are the different hedging methods. We've all discussed this. We've all discussed all the hedging methods. They compare between certainty, flexibility, cost, and upside potential. You can compare all of this, right? And then there's a full-fledged example as well. You can go through this full-fledged example. Now quickly moving ahead to how do you do a statement of financial position hedging, which is how do you address the translation risk. We already discussed earlier in this chapter how do you hedge the economic risk. How do you hedge the economic risk? You hedge the economic risk by diversifying what? Your operations, suppliers, procurement, your production, your customers, your financing, everything you should diversify to diversify your, or rather to reduce your economic risk. So if you want to reduce your translation risk, now all the hedging methods were to do what? Were to hedge your transaction risk. Economic risk I just told you, and then if you want to hedge your translation risk, you have to make sure you are matching the foreign assets with the foreign liability. Effectively, if you have a subsidiary in Australia, what will you do? To hedge the assets, you will try to borrow. In Australia. So you will take a loan in Australia itself, so that if the Australian currency goes down, your assets go down, but your liabilities also go down. So effectively, the net risk is zero. This eliminates the translation risk. Okay, this helps eliminate the translation risk. The priority in life should always be to hedge the transaction risk, which is a cash risk and which is the short-term risk. Okay, I hope this chapter is clear. We'll quickly move to this is all of course summary, so you can go through all of this. We'll now move to the next chapter, which is interest rate risk management. Interest rate risk management we'll quickly move to. Are you with me till here, guys? We'll move to interest rate risk management, then we'll move to business valuations. Okay, are you with me till here, guys? I'll wait for 45 seconds. Yes, asset liability management for translation risk. I'm getting a few yeses. Yes, Pooja. Yes, Parvesh. Yes, Ruchi. Superb. Yes, Nizia. Super. Let's quickly start with the next chapter, which is interest rate risk management. Anyone who's watching recording, I will take one help from you, one request. Anyone who's watching the recording later, afterwards, please put the timestamps by chapter. It will be very helpful to all the new viewers. Okay. Now, what happens to the interest rate risk management? What are we saying? We are saying that whenever you borrow money, okay, there's two problems that occur. There are two options of borrowing money. When you borrow money, you can either borrow at a fixed rate. For example, you are taking a loan of 10%. 10% is the fixed rate bank loan. Okay, irrespective of whether the repo rate is what? Basically the central bank decided rate. Irrespective of whether the central bank decided rate changes or not, the fixed rate will never change. But there is something called as a floating rate. For example, there is something called as LIBOR plus 4%. There might be a rate like this, which is London Interbank overnight rate, LIBOR plus 4%. This is called as a floating rate, which means the central bank of UK can change this rate. And let's say if today the rate is 3% and 3 plus 4 becomes 7, tomorrow they can increase the rate. To 9%. So 9 plus 4 will be 13%. So now the risk is what? If you have borrowed in a floating rate, and what if the LIBOR goes up? That is the risk, because then your floating rate increases. But if you borrowed in a, so someone will say, sir, let us borrow in fixed rate. The risk with the fixed rate is, if you borrowed in a fixed rate and what if the floating rate goes down, that is also a risk. So number one risk is fixed versus floating rate. Okay. Number two risk is what? Number two risk is your timing risk. Which is if you are standing on what? If you're standing on 1st January. You have decided that I will borrow on 31st of March. Now between 1st of January and 31st of March, what if the rate changes? That is the second risk, which is the timing risk. So the interest rate risk is nothing but your changes in the estimated cash flows, uncertainty in the cash flows because of changes in the interest rates. Okay. Next, there's also a basis risk, which is offsetting positions don't move perfectly together. For example, you will have your assets which are a particular base rate linked, and liabilities which are also linked to a base rate, but this is a different base rate. They are linked to LIBOR. When the base rate rises 0.5%, LIBOR is rising only 0.4%. So even though they are exactly the same amount of asset and liability and both are floating, the rate to which they are linked, for example, assume one of them is linked to the US's central bank rate, one of them is linked to the UK's central bank rate, they will never be or they will most ideally not move in the same move to the same extent. Direction might be the same, extent might not be same, and hence there will be some net gain or net loss. Okay. Third one, this is if the assets and liabilities were both floating and they were both the same amount. But what if your liabilities are more than your assets? What if your assets are more than your liabilities? What happens then? If your liabilities are more than your assets, then you are susceptible to what? Then you are exposed to the case scenario where your interest rate rises, because then you'll have to pay more on the liability. But when your assets are more than liabilities, then you are exposed to the falling rates, because if the rates for assets fall, you will have a more loss. There's an example as well: 12 million assets, 80 million liabilities. There's a 6 million gap. If the interest rate rises, right, by 0.75%, there will be a net loss to the extent of 22,500, which is nothing but 6 million into 0.75%. Okay, there's some examples as well given, which you can take a look. Moving to the concept of yield curve. Yield curve is what? Yield curve effectively does what? It will plot the yields. It will plot the yields on the y-axis, and it will plot the maturity on the x-axis. For example, 1 year, 2 year, 3 year, and 4 years, and so on and so forth. 1 year rate could be 3%, 2 years rate could be 4%, 3 years rate could be 5%, and so on and so forth. So there could be most likely there will be a rising yield curve, normal upward yield curve. Okay. Term structure yields typically vary by maturity. The longer the maturity, the higher the yield. Yield is what? Yield is effectively the interest rate. Yield curve is typically there for risk-free securities like the UK gilts. Okay. Now, there's a gross redemption risk, which measures the total, which is the total return measure for the yield curve. Okay. This is effectively the interest yield plus the capital gain. This is represented on the chart of the yield curve. Now, what are the different types of shapes? One shape is the normal upward curve, where the long-term yields, long-term interest rates are more than the short-term interest rates, and that is most of the cases. Long-term interest rates are more. Typically, interest rates will be rising in the long term. But there could also be an inverse downward rate, where short-term yields are actually more than the long-term, which is where you are expected, it is an expectation that the rates will now fall, in which case there will be an inverse yield curve. Okay. There could also be a flat humped or a steep upward curve, which is basically similar short and long yields, or which is when there are dramatically long-term higher yields. Now, expectation theory says curve effectively reflects future positions. If it is an upward facing curve, it means the interest rates are expected to rise. If it is a downward facing curve, the interest rates are expected to fall. Okay. Liquidity preference theory. Why? The investors will prefer liquidity, and hence if they have to invest for a longer term, typically they will require a premium to invest in a longer term, and hence they will require higher interest rates. Okay. But having said that, different types of investors will want different types of segments. You can take a look at this one. Now, what happens and what is your role? What is your role as a financial manager? How is the yield curve applicable to you? Never forget, all of these concepts are there for a reason. How do you as a CFO take help of these? So if you know that the rates are going to rise on the longer run, will you take a floating rate today? Knowing the fact that the rates will rise and floating rate will rise, why will you take a floating rate loan? You will take a fixed rate loan today. You lock the long-term fixed rate today. You will lock the long-term fixed today. Okay. And you will avoid a long-term variable borrowing. You will avoid a long-term floating. But we know the rates are going to fall. Why will you today borrow at a very high rate and you keep a fixed rate? You will borrow at either a long-term floating rate, or you'll borrow at a short-term fixed rate. Or if you are investing, then you will say, I will invest, let me lock the high interest rates today. So you will invest in the long-term investments. Okay, now this is clear. Example is given where the curve 1 year is 4.5, 5 year is 6.2. So it is going up. If it is going up, so term structure looks at debt only. Sorry, I'm not sure what you're trying to say. You are saying, should we talk about investments or should we talk about borrowing? Is that the question? I didn't get your question very well. So what happens for Zenithco? Zenithco says you are expected that interest rates will rise a lot. Should you borrow or not? They need a borrowing. What do you do? So you will say, I will fix. Should I do? What should I do? I know that the interest rates are going to rise. Should I borrow? So I have two options. I will borrow at the fixed rate for 5 years, or I will take the year one variable rate and then I will go for the locked in rate at the higher rate, whichever gives me the cheaper option. The first option is cheaper. You lock the fixed rate today, so you should go for the cheaper option. Now, how do you calculate the forward rate? How do you calculate the forward rate? If you have a 2-month rate given and you have a 6-month rate given, what is the rate from second month to 4 month? You have a 2-month rate given, you have a 6-month rate given. Okay, what is the rate of interest between the 2 months and the 4 month? So let's say if you are standing at year 0 or time 0, let's say you are standing at time 0. Term structure of interest rates looks at maturity of debt or borrowing only and not investments. No, I agree. It talks about borrowing from a CFO's perspective, but it also effectively, if the borrowing rates increase, your deposit rates will also increase. It's not like ever only borrowing rates will increase, right? Now, at 6 months and you are at 2 months. Okay. So what you have a rate of interest which is from T0 to 2 months, you are getting 3.8%, and from T0 to 6 months, you are getting 4.4%. What you need to calculate is effectively what is the borrowing rate between this period. Okay, how do you do it? You will say that 4.4%, what is the applicable rate? 4.4% for 6 months, it is 2.2. So 1.022, okay, which is 2.2% is equal to, you will say it is nothing but 1.038 proportionate for 2 months. So 1 plus 0.038 into 2 by 12, this whole multiplied by 1 plus R. What is R? R here is the rate that is applicable for the next 4 months. Into 4 by 12. Now when you solve this and you find out this R effectively is 4.7%, which is going to reflect the expected 4-month rate of the borrowing in 2 months for now. What is the 4-month rate? Okay, I hope this is clear. Now forward rate agreements, I think what you are trying to say, Vriddhi, and I'm not sure if I got that correctly. You are basically saying that from this chapter perspective, we are solving for only borrowing risk, not investment risk. I am assuming that is what you meant. Just confirm. The FRAs, the first way to hedge the the interest rate risk is FRA. Remember, we also hedge the foreign exchange risk using the forward rates. FRA is equivalent to, it's a parallel, it's not equivalent, it's a parallel to the forward contracts for foreign exchange rate. It's a parallel to that. What happens here? You lock in the future rate. Just the way you locked in the exchange rate over there in foreign exchange forwards, you are going to lock in the future rate. If it says XY, okay, you meant to say this chapter covers only borrowing. Yes, that I understand. I was giving a general explanation about yield curves. I was giving a general explanation about what happens to investments also. This chapter and the course might contain only to borrowing rather than investment. Fair enough. Now, XY FRA effectively says, so in our example, 2 to 6 months, effectively we say 2-6. 2-6 effectively means borrowing in 2 months from now, for next 4 months. That is what FRA will show. Okay, That is what FRA will show. And when given a quote like this, always remember, when you borrow from the bank will always charge higher from you. But when you invest, the bank will always give you lower, because bank will earn a margin between the two numbers. Okay. Remember, company will always take a loan at the market rate when the borrowing begins. FRA is again a separate contract with the bank. FRA is a separate contract with the bank. Its actual borrowing will be separate. So what does it mean? If let's say your FRA rate is 5%. FRA rate is 5%. Now, when you actually borrow from the market, there are two scenarios. The market rate is 4.5%, the market rate is 5.5%. So what will you do? There will be two transactions. Number one, you actually borrow at the relevant rate, which is 4.5 and 5.5 respectively. But number two, what happens? You will have to settle the FRA. You have to settle the FRA, where you had told the bank that I commit to borrow from you at 5%. That is what you had committed. So even if the market rate is lower, the bank will say you had committed you will borrow at 5%. You give me the extra 0.5%. You give me the extra 0.5%, and hence your effective rate will be 5%. Now, if the market rate is higher, you will go to the bank and say, I had told you I'll pay only 5%, but I'm having to pay 5.5%. You compensate me to the extent of 0.5%. So the bank will pay you. It will be again for you the 0.5%. So your effective rate will be only 5%. So FRA locks the interest rate. Okay. It says, I will go through an example. We'll go through an example of borrowing. Okay. Which is Meridian needs 12 million in 3 months for 5 months. Okay. So is it 3-5? No, you need 3 in 5, or you need in 3 months for 5 months. So 3 plus 5 is 8. So 3-8. Okay. So 3-8 FR is available at 540, 515. Now you had to borrow. So you will take the higher rate, which is 540. So you will buy FRA at 540. Now the market rate is 680. If the market rate is 680, you will actually borrow from the market at 680 and pay the interest at 680. But FRA will compensate you. FRA will say you had to pay extra 1.4%, which is 6.8 minus 5.4. So FRA will say, okay, take the gain from us. We will give you that extra money. So your net interest rate will always be fixed at 5.4%. Now market rate is lower, so you'll pay lower to the market, but the bank will say, now you'll have to compensate towards the remaining 1.2%. So hence your effective rate always is 5.4%. This is a question where you already know the answer. You can easily check the answer. This is as easy as it gets. Okay, so I hope this part is clear, guys. Now moving to the next topic, which is, I hope the FRA concept is clear, guys. For all those of you who are watching live, please let me know if the concept of FRA is clear. Before I go to interest rate guarantees, is the concept of FRA clear? Is the concept of FRA is clear? There's always a lag between when I speak and when the feed comes live. So there's always a gap of 30 seconds, 45 seconds, etc. Bhargav says yes. Cool. Let's quickly move ahead. Now, talking about interest rate guarantees. Interest rate guarantees, which is nothing but an option on the FRAs. Option on the FRAs, Ruddhi says yes. So there's an option on the FRAs which basically says you have an option to exercise it or not. You have an option to exercise it or not. It is a right but not an obligation, and because it is a right, you will have to pay a premium. You will exercise if the interest movement is adverse. If you wanted to borrow, and the rates have moved up, but you had locked the rate of FRA, so you will say I will exercise the FRA. But if you wanted to borrow and the rates have moved down, so why will you pay the FRA rate if you can borrow from the market at cheaper? You will not exercise. Okay. In case of FRA, if you for sure know it will move in adverse direction, you take FRA. But if you don't know which direction it will move, you go for interest rate guarantees, and you pay a premium where you want an upside. Okay. Second, interest rate futures. Interest rate futures similar to foreign exchange futures. These are exchange traded. These are exchange traded contracts where future prices will move inversely to the interest rates. Why? What are the future prices? Future prices are quoted at 100 minus future interest. Future price are quoted at 100 minus future interest. Okay, so what happens if today hypothetically the interest is 3, then future price will be 97. If the interest increases to 5, the future price will reduce to 95. So what do? You will say the way you have to decide whether you sell the future or buy the future. How do you decide? This is one confusion that all the students have. So how do we decide whether do we sell the futures or buy the futures? Okay, you are going to borrow. You are saying I want to borrow. Okay, I want to borrow. What am I afraid of? What am I afraid of? I am afraid of rates going up. If I'm afraid of rates going up, then I need to take a position where I benefit if rates go up. Okay, my rates go up, if interest rates go up, because there's an inverse relationship between future price and interest price. If rate of interest goes up, the future price will come down. As you can see, interest went up from 3 to 5 and future price came down. So if you are sure that interest rates will go up, which means you want the future price to come down. In what situation will you benefit if the future price come down? Only situation where you benefit if the future price comes down if this means is future price goes down. This is where you benefit. In what situation does future price go down? Where you sell now at a higher future price. You sell at a higher future price and then buy later when future price goes down. Okay, when future price goes down. Is this clear, guys? Is this clear? Where you have to borrow, you will sell the futures, because you would want that when the interest rates go up and the future prices go down, you will buy the future price, you will buy the futures at a lower price. Okay, in this case also, as the case is with FRA, the actual loan is a separate transaction. Future profit or loss is a separate transaction. Remember, futures is always a separate transaction. Borrowing is only notional. If you want to borrow, you sell the futures. If you want to borrow, you sell the futures. Okay, borrowing, sell the future. BSDB. Borrowing, sell, deposit, buy. Okay, always remember. As you can see, rates rise, higher interest cost, future price falls, then you sold it at high, buy at low, so you will have a profit, but you will have to pay a higher interest in your market. So higher interest, but you have made a profit, so net amount will be lower. So profit and loss on future offsets the loss or gain on loan, effectively locking the interest rate. Futures like FRAs also will lock the interest rate. Okay, futures like FRAs also will lock the interest rate. The only problem is always future price and spot prices are not the same. Future price and spot price are always not the same. That is the only issue. Okay, next is the way we had options in case of futures. Same way we have options in case of interest rates. The same way we have options in case of interest rates. What? So you will say there is a cap. There's a cap which is the maximum amount that you will have to pay. So cap, as the name suggests, it's a cap. And a floor means minimum amount. If you are an investor, floor means minimum amount that you will be able to invest it at. Okay, so if the market rate is lower than a cap, if the market rate is anyways lower, you will borrow from the market. Why will you exercise your cap option? You will borrow from the market. But if the market rate exceeds the cap, you will say, I'm going to exercise the cap to make sure my upper liability is limited. In case of investors, what do? If the market rate is higher than floor, you will invest at a higher market rate, right? Because that is giving a benefit. But if the market rate was lower than floor, then you will say, I will exercise because I need a minimum return. What are collars? Collars are what? Collars will effectively say that you have to pay the premium on the, if you are buying the cap, you will have to pay a premium, but premium is very expensive. So what do? You will pay a premium, but then you will sell the floor. You will sell this floor. Okay, you will buy the cap, you will cap the option, and you will sell the floor, which means you will also have a minimum borrowing amount. So let's say, as an example, 10 million of debt. You buy the 6.5% cap, which is the maximum interest that you pay will be 6.5%. But when you sell the floor, you are giving someone else the right to invest at 4.5%. if someone else gets the right to invest at 4.5% and the actual interest rate in the market is 3.5%, he will say I will exercise the floor, which means for you the minimum interest rate is fixed at 4.5%. So the range effectively is 4.5 to 6.5. If by the way, let's say the interest rate is 5%, what do? The interest rate is 5%, both options lapse. But if the interest rate is 3.5%, the cap lapses but the floor is exercised. If the interest rate is 7%, then you will exercise the cap. You will say, why should I pay higher in the market when I am able to exercise the 6.5% option? Okay, this is the concept of caps, floors and collars. Moving to interest rate swaps. Agreement to exchange for a floating interest rate. So let's say there are two companies. I have borrowed at a fixed rate. Another company has borrowed at a floating rate. But I want floating, the other company wants fixed. We will exchange our interest streams. I have a floating rate. The other company has a fixed rate. Okay, so I will swap. I will take the fixed. I will give him the floating, and hence my net debt will actually get, my floating debt will get converted to a fixed debt without the refinancing. Okay, is it clear till here? Guys, you will have to read the chapter of interest rate risk management. In fact, both these chapters, but especially interest rate risk management from your end, you'll have to solve a few sums that will give you the best amount of clarity. No amount of theoretical discussion here from my end or revision will help you. See, I can give you all logics, okay, but the perfect clarity will come only when you have practiced it from your end, guys. I'm telling you, especially for this chapter, revision cannot be the only way of revising. I can give you the concepts, make it clear for you, and that's the best I can do in a 10-hour revision, but you'll have to solve as many questions as you can. Is it clear till here? I'm going to pause for the next 1 minute. Is it clear till here, guys? Please let me know. I'm going to pause for the next 1 minute. Please let me know. And after this chapter, we'll again take a 5-minute break before we move to the next chapter, which is business valuation. Okay. Clear? Sounds good. Now, there are certain non-derivative methods also. Which is what? Where you try to go for matching and smoothing. What is the difference between matching and smoothing? The difference is when you match, you try to match assets and liabilities with similar maturities. You try to match the maturities. When you go for smoothing, you try to keep a balance between fixed rate and a floating rate. Because what if you keep too much floating and the interest rate goes up? What if you keep too much fixed and the interest rate moves down? Okay. So cash flow matching, which is having an equal amount of interest sensitive assets and liabilities, so that if it goes up, both go up, comes down, both come down. Okay, this could be tested in section A and B. Both these topics could be tested in section A and B, guys, which is objective type questions. Second is duration or asset liability matching, which is you should match your duration. The duration over here means what? Basis risk means the difference between future price and current spot price in currency, not in currency future. Basis risk means the difference between in interest rate futures. Basically, there are two basis risk. Okay, there's two types of basis risk. One is the basis risk over here. The other one can call it a base risk, not a basis risk. This could be called a base risk. Okay, you can call this a base risk, which is the base rate is different. Okay, this could be called as a base. If you're getting confused, call this a base difference. Okay, this is nothing but the base rate is different, and this one, don't get confused, this one is a basis risk, which is when your future price is not equal to the spot price at expiry. Okay, clear? Now, match the interest rate sensitivity of the assets and liabilities. You will say, what is the difference between the first one and the second one? When you talk about cash flow matching, we will say exactly the tenure, if it is a 7-year asset and a 7-year liability. But the duration, remember Macaulay duration, for those of you who would have studied Macaulay duration. Okay, and even if not studied, that's okay, forget about it. Basically, there's a concept called Macaulay duration, where duration does not mean, okay, it is a 7-year bond, so it does not mean it is 7 years. The duration will be slightly less than 7. This duration word, Macaulay duration, talks about in how many years do you recover the present value of your cash flows. Don't get complicated. This is a simple concept. You just say you assume there's a way to calculate the number of years. Okay, you have to make sure that gets equated. Okay, so the duration needs to be matched for the asset and the liability. So match duration so that assets and liabilities respond equally. Okay, as you see, earlier assets had a duration of 3.2 years, liabilities have a duration of 7.8, which is there was a gap. Now you will try to make sure both have the same duration. Next one was interest rate smoothing, which I told you that you try to have a balance between fixed and floating rate. See, if you have all variable, then what is the issue? All variable will mean 3.12 million interest at the current rate. 3.12 million interest at the current rate. All fixed will mean this. 50-50 will be this. If the interest rate rise, then your variable will rise disproportionately. But your fixed will still remain fixed. So then if you keep a 50-50 mix, you'll be here. But if your rates fall, then you would have said, oh, I should have not borrowed fixed, I should have borrowed floating only. So the best way is to take out a middle way and to go for a 50-50, because this gives you a moderate exposure. This is a partial protection and a partial flexibility. Okay. Is this clear? Any doubts from the interest rate risk management chapter? I'm going to give you a couple of minutes. Or actually, why don't we take a break in the interest of time, because there's also a lag between when I speak and this comes on your screen. Let us take a break of 5 minutes. Any doubts from the interest rate risk management chapter that you have, please ask me once we come back, and then quickly we move to the business valuation chapter. Okay, see you after a 5-minute break. Bye. welcome back. And I didn't see a lot of doubts, or not a lot of doubts. I didn't see any doubt on the chat box. So I'm going to get started with the business valuation chapter. As you all are back, just put a hi or a thumbs up or a yes in the chat box so that I know you all are back after the break. I'll get started with the chapter of business valuations, which is, if I'm not wrong, section F of your syllabus. Okay. So why do you have to value businesses is the first question. Very simple. If you have to raise new equity, if you have to go for an IPO, if you want to sell your buyer company, which is merger and acquisitions, unfortunately, if this is a divorce settlement, and if it is a management buyout, in all of these cases, you have to value the company. But also, if you have to buy and hold in a company, if you have to value the shareholdings of a retiring director, if you have to value the employee stock option scheme, then also you value the company. How do you value the company's total outstanding equity? You will simply say what is the share price into the number of shares. But what is the problem? The share price is fluctuating. It does not reflect your actual value. Plus, if it is an unlisted company, you'll never have a share price. Okay. So what do? See, the thing is, valuation is an art and not a science. In fact, I have seen that personally when I was in private equity, which of course is into the business of investing into companies, right? The real worth really depends on the perspective of the shareholders. There are different methods to do the valuation. Every method will give a different valuation. Plus, of course, buyers will say we want to buy cheaper. Sellers will say I want a higher value. And the context of the industry also matters, and the effective valuation is always, and I repeat, always determined by the negotiation between two parties. There's a very, on a side note for 30 seconds digression, there's this video where there's a girl who negotiates with a guy who's wanting to cast her in his film. He says, I will not pay you anything, it's an experience. The girl says, I will charge $400. And then they keep negotiating, and then they probably come to $50, and the guy tells her, I would have paid you 100 also if you would have asked for it, but you agreed for 50. And the girl says, I would have done it for free. So that's the power of negotiation, where you come to a middle ground and you go for it. Okay. So always in the examination, explain that valuation involves subjective judgment and compromise, and eventually the valuation gets determined by what is the negotiation. Okay. What are the information that you need for negotiation? You'll need the financial statements of the company, you'll need the supporting schedules, you need any contracts it has with customers, with suppliers, you'll need future projections, because of course eventually not only historical information but future information also, because your value of any asset is the present value of all the future cash flows. Finally, also the industry analysis and key personnel, everything will matter. Okay. Now, the limitation is budgets might be overly optimistic, projections might be overly optimistic, etc. Remember, investors buy the businesses for what? For the cash generating ability of this business, for the future cash generating ability. Okay. Now, there are different methods to value a business. All of these are very important from an MCQ perspective. Again, section A, section B, right? In fact, I think one of these was also probably not tested in June, but it was definitely very important. So asset-based methods are based on valuing tangible assets. This could be asked as an MCQ. Not intangible. Remember, not intangible. That is false. That is false. Not intangible. Okay. This is more suitable for businesses which really have a lot of tangible assets, like real estate businesses, manufacturing businesses, those that help in determining the minimum prices for takeovers. There are 4 types of methods. One is the book value. Now you know what book value is: historical value, a balance sheet value, but this is often meaningless. What do you do with the book value? There is a net realizable value, which is if you go on to sell this in an orderly disposal. Okay, what is the amount that you will get if you were to sell the business, right, in an orderly disposal? What is the value that you get for all your assets? Remember, this is the minimum acceptable value. This is the floor value for the seller. This can be tested in an objective question. This is the minimum value. What is the replacement cost? Which is the cost to recreate the business from scratch. If the buyer who is buying from you would have instead of buying from you, would have created this business from scratch, what would have been the amount that the buyer would have spent? So this is the maximum value that the buyer should give you. Otherwise, the buyer will say, why should I pay you higher than what it costs me to build the same business? Okay. And then there is also a breakup value if the business has ceased to trade, if it is no longer a going concern. Then if these assets are sold piecemeal, what does piecemeal mean? Piecemeal means if it is sold in parts. Then what is the price? This is the minimum acceptable price for the sale of a going concern. Okay. Now the deprival value is the loss that the company would suffer if deprived of the asset. In practice, however, this is normally lower than the replacement cost and the recoverable amount, and hence you go ahead with the replacement amount only. What are the strengths and weaknesses of asset-based methods? Is often readily available. It gives you a realistic floor price. However, book values are based on historical cost. NRV, which is net realizable value, is problematic because when the company is in a distress sale, let's say Kingfisher, right? Airlines, for example, which belong to Mr. Malia. Now, even if they sell off those assets, they will not get as much as value as you would have normally got in case of a going concern. Why? Because now the buyer also knows that it is the distressed sale, so the buyer will also charge higher from you. Okay. When the asset-based methods are useful, number one, in case of an asset stripping, the company purchase to be broken up. Okay, when you know that you will not be able to sell the business as it is, you'll break the company into parts and then you sell. Number two, the minimum value is the floor for takeover negotiations. Okay, which is, you will say, why should I accept a value which is lower than this? Because even if I break it into parts and I sell, I'm still going to get a minimum of this value. And number three, for property compliances, because asset values correlate with the cash flows, because the asset values and the cash flows are directly correlated. So for profitable companies, however, the minimum acceptable price is the market capitalization. For profitable companies, you will not see my minimum acceptable price is the breakup value or is the net realizable value. You will say, in case of a profitable company, if my shares are already trading at a particular price, why should I accept a price which is lower than that? So that is your asset-based methods, definitely possible from a section A and B perspective. Now coming to income-based methods. Income-based methods, very simple. If someone is going to buy the majority shareholding of the company, then what will they do? They will not focus on dividend, they will focus on earnings, because dividend they can influence. If they are majority shareholders, they decide how much of dividend to give or not. So they will say, I'll focus on the earnings. So there's a ratio called as a PE ratio. There's a ratio called as a PE ratio, which is nothing but the market price divided by the earnings per share. So your company value is effectively nothing but your earnings into the PE ratio. Where do you get the PE ratio from? PE ratio could be an industry PE ratio, and then you adjust. If it's an unquoted company, you adjust the P ratio from comparable quoted company to value an unquoted company. How do you adjust? And there is no right number. Let's say if the quoted company P is 15, you will say unquoted, I will take a 10% discount. Why? Because unquoted companies are non-liquid. The shares of unquoted companies are non-liquid. So you will say I will give a discount. So I will value the unquoted company at a PE of 13.5. Now this 13.5 could be 13, could be 14. There is no right answer. 10% is an arbitrary number. So please put this as an assumption, saying 10% is just an assumption. The actual number might differ based on the negotiation. However, unquoted companies are always quoted at a discount versus the quoted companies. Okay. Now, how do you interpret these P ratios? High P, this also could be asked in section here B. High P effectively indicates high growth, because if you are expecting the company to grow very fast in terms of earnings, you will be willing to, as an investor, you will be willing to pay high for the company. And if the current earnings are depressed, then also the P ratio might be inflated. Why? Because the value of the company being the same, the current earning, which is the denominator, is depressed, your P ratio will be inflated. Versus lower P will indicate exactly the reverse, which is expected profits to decline, so your valuation will be lower. And number two, if you know that the company has a higher risk, you will say, even if the industry is trading at a 10x, I will give you only a 8x, because you are having a lot of risk. The problem, however, is how do you find out exactly comparable companies whose P ratio you can use and value? Accounting policy also differs. Remember, we had discussed yesterday that profits are a myth. Profits are only opinions. The only facts are cash flows. Okay. Plus, you must adjust your earnings to maintain to maintainable or normalized levels. Okay, there could be one-offs. For example, there could be director's remuneration. What if that director has left? There could be certain one-offs which you will have to adjust. Okay. Plus, management will say, I will manipulate my reported earnings, because my ESOPs are based on that, which my employee share options are based on that, which is if I'm going to be taken over, I will try to increase the earnings so that my value increases, and so on and so forth. Okay. What do? You will reduce the P if the company is unquoted or private. If it is a smaller company, it's a higher risk, you will reduce. If it has lower growth, you will reduce the P versus the comparable. But if it has a higher growth potential, if it is a superior market position, you will increase. Per reason, you will put a 10%. This is arbitrary. There is no right answer. But the explanation is more important. This amount is less important than the explanation. What should you do from an exam perspective? You should take a profit after tax available for ordinary shareholders only, that is after the corporation tax and after deducting any preference dividends, but before the ordinary dividend. So you should always take PAT. You should always take PAT before, or rather you should take PAT after preference dividend. Why after preference dividend? Because you are valuing only the equity shareholders. So you will say, I will pay the preference shareholders first, and then whatever remaining PAT is there, I will multiply this PAT into the PE ratio, and always do this for the maintainable earnings. There's an example given. You will take 480, you will minus the preference dividend, this is the earning, you will multiply this by the PE ratio. Okay, but this is an unquoted company, so you will calculate the unquoted, right? Then you find out the value for the company. Okay, so the value for the company is this number finally. Okay, I hope this is clear. What is the earnings yield method? It is absolutely the inverse of P ratio. If you see, what was the P ratio? P ratio was PAT by EPS. P ratio was, or not PAT by EPS. It was your P ratio is price by earnings. So your share price by your earnings by your EPS. It is per share basis, price by earnings, correct? If you see the earnings yield, it is nothing but EPS by the market price. By the market price, it is the inverse. So effectively, earnings yield is nothing but 1 by PE ratio. It is the inverse of PE ratio, and hence total valuation is what? Think of it as you will keep earning a particular earning perpetually. This is a perpetuity formula, which is 1 by R, or I would say cash flow by R. So earnings divided by the earnings yield is the percentage of the yield that will give you the value of your company. Okay, that will give you the value of your company. Hi Mehal, the question I think is, can I share the full PDF without any annotations? Unfortunately, that book is only for those who've bought the lectures. And in fact, I was not supposed to share my notes also, but I was really insisted, and which is why I'm sharing the notes with the annotations. But unfortunately, I won't be able to share the clean notes because that is meant only for the students who've actually purchased the lectures. Coming back, if there was going to be a growth, then what happens? If there's going to be a growth, then earnings into 1 plus G divided by earnings yield minus G, which is similar to the dividend yield formula. Remember, I had told you for perpetuity as well. I had told you for perpetuity as well, cash flow 1 upon rate minus G. For dividend also, remember, we do this. For dividend also, we say dividend valuation method, D1 upon KE minus G. Similarly, the company value for earnings yield plus growth is earnings into 1 plus G divided by earnings yield minus G. This adopts the dividend growth model, replacing dividends with earnings. Remember, earnings yield method or the P method is for the majority shareholders because they can influence the amount of dividend that is paid. Okay, but if you are a minority shareholder, then in that case, you will go for the dividend valuation method if you are a minority shareholder, because you cannot influence the dividend. So whatever cash flow you are getting in the form of dividend, you have to happily accept it. And this formula we have already discussed yesterday, so I am not going to repeat it. While determining cost of equity, that chapter we've already discussed this formula, so I'm not going to repeat it. Once you have found the price, this ex dividend price, remember we had discussed yesterday. Once you have found this price, then you will say the value per share into the number of shares will be the market capitalization through the dividend valuation model. X cum dividend we've also discussed. Y X dividend we've discussed. Logically, once more, X dividend is because the buyer of the shares does not receive the dividend. The dividend has already gone to the previous owner, which is the seller. But cum dividend, when the dividend has been declared but not paid and the seller is selling, the seller will say, but you are going to get the dividend, no, on my behalf, so I will also charge you for the dividend that I am going to get. Okay, if the new owner is going to receive, then it will be cum dividend. Okay, strengths and weaknesses you can read, it's fine. The dividend DVM with growth, we have taken look at an example yesterday, so I'm not solving an example again. Next one is Gordon's growth model. This also we've taken a look yesterday, which is G is equal to R into B. R is what? Return on equity, ROE. B is what? Retention ratio, which is 1 minus the dividend payout ratio. Okay, I hope this is clear. I hope this is clear. Any questions still here, guys? I will pause for the next 1 minute. I just noticed, by the way, my streaming reaches to you after 20 seconds. So when I say I will wait for 30-35 seconds, I will wait for 20 seconds just because it goes to the YouTube 20 seconds later. Plus you will type another 10-15 seconds later, and hence by default I'll have to wait for 40 seconds. But any doubts still here? Is it clear, and can I move to the next topic? Please let me know. Any doubts? Someone has said I've done BPP 1 time and Kaplan 2 times for section A and B. Is that enough? I do believe it is enough, but remember, no amount of practice can help you unless you actually write down whatever your mistakes are and you go through those mistakes a day before exam, right? Because you might solve the questions right now, but what if you don't remember? So it's important to write down your mistakes. So the tip for remaining days, what I have already given earlier in this lecture, is that you should practice as many questions as possible. You should write at least 3 mocks, and that too on the practice platform itself, right? You should write 3 mocks on the practice platform so that you can practice. And you should do what? You should create a mistakes tracker for yourself so that the day before exam you can go through all the mistakes that you had made so far and you don't repeat those mistakes. And needless to say, at least investment appraisal is going to be a short question in the examination, so do prepare investment appraisal from a section C perspective very well. Okay, that's how I would put it. And I'm assuming when you practiced BPP and Kaplan, you had marked all the important questions, or at least where you were getting wrong. It is important to revise those when you get closer to the exam last 3-4 days. Okay, any other questions, guys? Given none more, I will move ahead. Yes, so when is DCF more important? Again, when acquiring majority, because when you're acquiring majority, you're obtaining the control over all the future cash flows, because you are going to value either the entire company or when you are acquiring a part of the company. Rationale is controlling shareholders will acquire the stream of future cash flows. Okay, if you're a minority shareholder, you value using the DVM, but if you're a majority shareholder, you can use the DCF. The DCF principle is what? Business value is nothing but the present value of all future cash flows. Guys, I've told you enough number of times, any asset is nothing but the present value of its future cash flows. In this case, the business is, what is the discount rate? Discount rate will be WACC, because the full business corresponds to the capital providers. Okay, what is the definition of free cash flow? We discussed the definition of free cash flow, but there's few changes. You discussed operating cash flow, we discussed cash payments. Okay, there will be whatever amount you incur towards capex, initial investment, new investment, etc. But if you sell an asset, also, that will be a part of the cash flow. And if there is going to be a merger, you will add those synergies also. These are the two separate adjustments, so please take a note of these. Next one is what? Next one will be, what should you exclude? Interest payment exclude. Why? Already a part of WACC. Already a part of WACC. Okay. What about loan payment? Loan repayments also you will ignore. Loan repayments you will ignore. Correct. Dividend also you will ignore. So any amount that you pay, or you receive from your equity or debt providers, you will ignore. Okay, so how do you calculate it? You will say, I will calculate the relevant free cash flows. I will select the horizon. Okay, select the horizon. Then I will calculate the present value of these cash flows, deduct the debt value from the equity, debt value from the value of the business. The value of the business, remember, value of business is nothing but value of equity plus value of debt, so you calculate the value of business, you reduce the debt value, and you'll be able to find out the value of equity. So value of equity is nothing but the present value of free cash flows minus the value of debt. Should you take real rate or you should take discounted rate? Guys, you should take real rate or you should take discounted rate. If the cash flows are in real terms, you use the real rate, but I have told you, for the sake of simplicity, is the same, the burger equation only. You should ideally use the nominal rate. The advantages and disadvantages of DCF, you can take a look at it. It is almost logical, risk adjusted, discount rate is adjusted with risk. It's a forward looking, whatever discount, whatever cash flows we'll get going forward, right? But estimates, uncertainty, terminal value, WACC estimation, highly sensitive to assumptions. All of these are a lot of assumptions, garbage in, garbage out. So if your assumption was wrong, then your answer will also be wrong. Okay. Now, if you see, they've calculated the free cash flow. What have they done? They have said revenue minus production cost minus expenses. Okay, minus expenses will give me an operating profit. Okay, so my operating profit was 197 before depreciation. This is my tax on before the dividend repayment. The tax into the TAD is the separate because there's tax relief, so I will add it back. And then there's a separate cash annual investment, so I will subtract the capital expenditure. So my net cash every year is 47.56. Using the inflation and using the inflation, what I've done, we've done the real rate calculation because all of these cash flows are in real terms. Okay, all of these cash flows are in real terms. Let me write it here. All cash flows in real terms. So if all cash flows are in real terms, what do? You will use the real rate instead of the nominal rate. If all cash flows are in real terms, you use the real rate, RRMM. Okay. Corporate value will be what? 47.56 divided by 9.2%, which is the real rate in this case because 47.56 is a real cash flow, not a nominal cash flow. Then what do you have? You have the debt. What is the value of the debt? Value of the debt is given in the question. Current debt 35 million, but trading at 135%. So 35 million into 1.35 will be 47.25. So total value of the business minus the value of the debt will be 469.71. 469.71. Is this clear, guys? Is this clear? Next topic is the valuation of debt and preference shares, guys. But valuation of debt and preference shares we've anyways covered in the previous chapters when we were calculating the cost of debt and preference shares. I also told you how to calculate the cost, but you can, once you have the cost, you can use the same to find out the value. This is effectively nothing but the present value discounted using the future cash flows. For example, preference shares, you have a dividend, it is a perpetual dividend because these are non-redeemable. Okay, irredeemable, this is like irredeemable debt, same logic. So total dividend or interest, as the case may be, divided by the rate will give you the market value. If it is a redeemable debt, then you simply take the present value of interest payments plus the present value of redemption value. This also we had studied in the previous chapter. Convertible debt is what? Market value is nothing but the lower of floor value, which is the redemption value, and conversion value, which is the value which is if you convert. This also we had discussed. Floor value is what? Floor value will be the present value of interest plus the present value of debt holders required return. Conversion value is share value into the conversion ratio. Conversion premium is the market value minus the current conversion value, which is current conversion. If in exam they ask you what is the current conversion premium, you say the market value will incorporate the value of conversion minus, if you convert it today, what will be the value. We will look at an example for this one. It is important to look at an example for this one. Examiners will give marks for the method, not just the final answer. First of all, you have to calculate the floor value. Floor value is if it was a straight debt. Basically, if it was redeemed, what was the value? That is the floor value. Then, if you would have converted, if you convert it today, if you convert it at a conversion date, then what is the value of the conversion? Now you compare the value, which is better. So you say, okay, if the conversion one is better, you explain that the conversion is better. Okay. Now you say, what is the premium? You will say the market value. The market value of what? The market value of the debt minus the current conversion value. Current conversion value is, if you convert it today, then what is the conversion value that you get? That is nothing but the value of the options. Let us take a look at, and you see there's going to be 2-3 marks for each calculation and then 1 mark for comparison. Okay. Now let us take an example. They are saying the coupon rate is 11%, face value is 100, and remaining term is 4 years. Conversion is 100 for 100 bond. 35 shares of 2.95 is the current price. Expected share price growth is 6%. Okay. And the debt holders required return is 7%. First of all, how do you calculate the market value? You will say, when I actually redeem, what will be the share price? The share price I have calculated when I actually redeem 6% growth for 4 years. Share price will be 3.72. Okay. So what is the conversion value expected to be in 4 years? The conversion value is expected to be 130.20. It will be 130. So you calculate the market value as we had done yesterday. Okay, now you calculate the floor value for a straight bond. The floor value will be 113. What is your current conversion value? Current conversion value, which is, if you convert today, what is the conversion value? 103. You will say the conversion premium is nothing but the market value today. The market value today, which is what? 136 minus what is the conversion value, which is 33.35. Is this clear? Any doubts over here? Any doubts over here? Market value will be higher of these two. Market value is higher of 136 and higher of 113. We've already seen this. This is the higher of 136 or 113. Or you could have simply also said 130 is greater than 100. Why do I even do this math? I don't need to do this math. I will simply take 130. I'll calculate the present value 136. Now I'll compare it with today's value. Today's value is what? Today's value is 103, and hence the conversion value is 33.35. Is this clear, guys? Any doubts still here? Let me wait 40 seconds, 20 seconds to reach you, and then 20 seconds for your comments. At least those of you who are live, please put a hi, thumbs up, yes, no, whatever in the chat box. Hello, Bhargav. Hello, Ruti. Any doubts, guys? Hello, Nizia. Super. We'll go ahead. The next one is market efficiency. The next word is market efficiency. Market efficiency, effectively, the key question is the share price a true, I would say, a true reflection of what the value of the company? So the share is valued at 1.5, is the true reflection. Now, effectively, if it is an efficient market, then it reflects all the available information with new information rapidly incorporated in an unbiased way. This is a theory which is called as the efficient market hypothesis theory. This also can be asked in a section C theory question, so it is important from a theory viewpoint. Okay, it's important from a theory viewpoint, which is, what does excuse me, what does the efficient market hypothesis say? It states that the security prices fully reflect all the relevant information. It cannot consistently outperform no one can consistently outperform the market without using the information except through luck. This is what efficient market hypothesis say, that market has all the information, no one can do better than what the market does. And if there is a new information in the market, it quickly gets incorporated into prices. Old information cannot predict future price movements, and hence there is no one who can do. But there are three forms of market efficiency. There is a weak form market efficiency, which reflects the past share price movements, Okay, so there is a technical chartist analysis who cannot consistently beat the market. Okay, if someone who is doing technical analysis, he cannot consistently outperform the market. It is important from an MCQ perspective. But if it is a semi-strong market, then all the publicly available information is incorporated in the price. Okay, so the technical chartist can still do better, but the fundamental guy cannot do better. Fundamental guy cannot consistently beat the market because he only has past information which is already incorporated in the share price. Okay, if it is a strong form efficiency, then in that case, all information, both public and private, is fully reflected in the, even if it is an insider information, it is fully reflected in the share price, and hence even insider information cannot consistently beat the market, let alone technical analysis, let alone fundamental analysis. Okay, in case of a weak form efficiency, technical analysis cannot beat you, but fundamental analysis can beat you. In case of a semi-strong market efficiency, fundamental analysis cannot beat you, but insider information can beat you. But in case of a strong firm efficiency, even insider information cannot beat you, because all the information is already available in the price. It is already available, and it is already incorporated in the price. So weak form efficiency has only past share price movements, okay, and there is no patterns on trends in the share price. But in case of semi-strong market efficiency, stock market is almost an actual stock market in life is also semi-strong market efficiency, which is only those trading within the first few minutes after the news can beat the market. Fundamental analysts using public information cannot consistently outperform, because the same information everyone has, and the price already incorporates that information. But the strong firm efficiency has all the information, but in reality markets are not strong firm efficient, because there are insider trading information that people have. People do get fined, insider dealers do get fined, okay. Insiders are forbidden from trading at crucial times, okay. So model code for directors dealings, directors cannot trade for 2 months before the annual results. In reality, because of this issue, they have the regulators have put a condition that directors cannot trade for 2 months before annual results or before any exceptional announcements. But in reality, markets are not strong from efficient, and hence insider trading is banned, okay. What does it mean? The implication for stock market is what? That the market is actually semi-strong form efficient. The market is actually semi-strong form efficient, which means the share price is fairly priced based on the historical information, except for the insider information. The managers do create value by investing in positive NPV projects, and fund managers cannot consistently beat the market using without inside information. Only inside information can help beat the market. Otherwise, markets are very smart. They know they have all the prices, okay. Therefore, the rationale for mergers and takeovers must be questioned, which is semi-strong firm efficiency actually implies that the mergers succeed only if the synergies are created. Otherwise, they will not succeed, because new information is already communicated to the market and it is rapidly reflected in the share price, okay. This could also be an MCQ. So now final question is fundamental analysis actually worthwhile? What should you do? If semi-strong efficiency is true, work of fundamental analysis cannot produce abnormal. Someone has said fundamental analysis can beat weak form efficiency. That's what I'm saying. In case of weak form efficiency, technical analysis cannot beat, but fundamental analysis can beat. In case of semi-strong efficiency, fundamental analysis cannot beat, but insider information can beat. And in case of strong form, even insider information cannot beat. You can rewind it 30 seconds back and you can see I had said the same thing. Now, in case of, so the market paradox is what? The market paradox says that although fundamental analysis cannot beat the market, large number of analysts are needed to ensure the prices adjust quickly, which means in reality what happens is, what are we saying? We are assuming that the price already incorporates whatever information has already been announced, but that will happen only if a lot of people have already absorbed the information and they have understood and they have already incorporated in the price. Almost the last topic is behavioral finance. Again, a topic which at least MCQs can be asked from, if not theory, which is it is a study of why investors make decisions that seem completely irrational in life. The efficient market hypothesis is not true. Markets are irrational. If it were perfectly true, why would the share prices move only in response to the real or breaking news? In real world, we see massive price swings even randomly. Okay, why does this happen? Number one reason, herding. Like us as ACCA students, we will say, oh, if X person is doing this, I will follow the same approach. This is herd approach, which is follow the leader mentality. Which is if someone else is buying or selling, if a big investor, big shot has bought a particular share, I will also buy that share. This is herd mentality. Then if other people also join the market, it is more validated because the price keeps moving up. There's also a stock market bubble. Okay, herding drives prices up again and again and again at unsustainable price, and one day suddenly the bubble bursts, which is what happened in 2008, the US housing market in mid 2000s, right? There are also noise traders who ignore the professional analysis, and fundamental data, who will only and only trade on the base of hype and trends. Okay, this particular chart is seeing a breakout, and is seeing a lot of volume. I will invest in this particular stock. But then because of this, there could be poorly timed entries and exits. There could be bigger players who have exited and retailers stay there without making profit. There could be a loss aversion strategy, which is there's a psychological tendency to fear a loss more than valuing a gain. So you will say, I don't want to make a loss, much rather safe than sorry. I will sell. I will sell, or I will invest in a low loss, invest in a low gain making company rather than a company where there's a chance of a bigger gain, but then there's a chance of a bigger loss also. Last but not the least, a momentum effect, which is once a trend is established, okay, then markets move takeover. If a share price has gone up by 10%, you are not realizing it's already gone up, it might not go further up, but you are saying, oh, it is going up, let me further invest because I think there's a potential to invest. So rising prices breed optimism, but if the same share price is falling, you will say it breeds pessimism. I think it will go down further. Even if it is already fallen by 10%, you will think it has further gone down. So what is the key takeaway of all of this? You will say, while the EMH assumes, EMH is what? Efficient market hypothesis. It assumes that all the investors, all of you and I, are rational. In reality, behavioral finance proves that this is not the case. Investors are actually influenced by the crowd. In the emotions take over and irrationality comes into picture. Okay, that's what leads me to the next topic, which is practical factors which actually affect the valuations, whether the company is private or public, which means marketability or liquidity. Okay, if it is a private, then the PE ratios will be lower. Okay, so from 10 to 30%. What is the available information? See, for unlisted companies, available information also will be lower, not so like unaudited statements, fewer regulations, so you will give a discount to them. Equilibrium prices, if there are sudden price, there could be sudden price fluctuations which are also unexplained by the new information. There could be highly volatile shares which are not in equilibrium. Okay, but however, price for unlisted shares, because they are unlisted, right, there is no sudden price movement, so they will always be in equilibrium. Lastly, you have to ensure that the P ratio that you take, the earnings ratio that you take, has to be comparable company, which is effectively it needs to operate in the same industry. It needs to be of a company of a similar risk profile also. The share prices have to be in equilibrium. Accounting policies are similar. It has to be at a similar growth stage, because even though they are comparable industry, one of them is fast growing, one of them is slow growing. If one of them is fast growing, then in that case, that company will have a higher P ratio. You can't take the same P ratio. If the other company has a different scale, it is much bigger, it might have a bigger P, you might have a smaller P, and you need to also make sure that the capital structures are similar. Without true comparability, the valuations lack credibility. Okay, this ends our section and chapter of business valuations. Any doubts, guys? Any doubts, guys? I will wait for you to tell me if there is any doubts. If there is any doubts, please tell me. Please let me know if there are any doubts. Okay, so guys, what all are we done with? What all are we done with? We are now done with investment appraisals. Investment appraisals. Investment appraisals we are done with. Okay, we are fully done with investment appraisals. We are fully done with business valuations. We are fully done with risk management. Okay, we are fully done with risk management. Section A and B, section A and section B, which is represented by chapter 1, 11 and 12 of my notes, we are fully done. This was to be done self-study. This was to be done as self-study. Okay, this one is ticked, this one is ticked, this one is also ticked. We have also done business finance. This was done yesterday already, correct? We've done business finance, correct, guys? Okay, this is also done. The only two things, if I was to say, is left is working capital management. Working capital management is left, which, guys, I have already recorded a video on. It is already uploaded on YouTube, so I will give you the YouTube video link. I'll update the description of this video, so you can find the description. I'll make this as a part 3. So working capital management, I have a full video explaining the entire working capital, management chapter. Okay, it is given, it is not given yet in the description. I'll just update the description of this video. So all, in which case working capital management also gets covered. Investment appraisals is done, business valuations is done, risk management is done. Section A and B, I had told you, because it is theory, I want you to self study this. Business finance is done. There is some theory on sources of finance, guys. There's some theory on sources of finance which you can read. I'm not covering that theory on sources of finance. That theory you should read it at your end. Please note it. That theory, which is, for example, bank overdraft, your commercial papers, Islamic finance, long versus long term versus short term borrowing. This is all theory in some shape or form. We've discussed all the practical aspects, but the pure theory, type of instruments, etc., that is pure theory. I think you can read it at your end. So this part you should read at your end. Otherwise, business valuation entirely is done, risk management done, valuation done, investment appraisals done, working capital management entirely. I've already recorded. It's already on my YouTube channel. I'll just update the link of my YouTube description. I'll give you the notes. Section A and B, again, I told you it's pure theory. You are best placed to revise it at your end rather than I. Again, notes are very helpful, so you can refer to the notes. The last thing that is pending is ratios. That is ratios, financial ratios and analysis. Now, if you want, we can take half an hour to cover the chapter of ratios. It is chapter 19 of my notes. But from what I know, you already covered this in the subject of FR and you know ratios very well. I can also show you the chapter. So now I will leave it up to you, all those watching live, if you want me to cover ratios live or not. Anyways, I don't think it is a chapter that needs live coverage. I think you can go about it at your end, because a lot of ratios we've already discussed. For example, how to calculate dividend, how to calculate P ratio, we already know all of that. A lot of ratios we've already discussed, right? Gearing ratio we've already discussed. ROC we've already discussed. So the chapter of ratio, more than 50% of ratios we've already discussed across all of these chapters. Like working capital ratios are discussed in the working capital chapter. Gearing ratios are covered in the capital structure. Investment appraisal ratio covered the ROC. Business valuation covered the PE and EPS, right? So a lot of these ratios are already covered. If you want, I can go about covering it very quickly, or else we can end the lecture over here and you can go about it at your end. You let me know what needs to be done. The only thing that is pending is ratios and working capital management. Working capital management, which is chapter 7 to chapter 10 of my notes, is already covered. Remember, it is already covered as a part of another video which I'm going to update in the description of this video shortly after. So for those watching live, just let me know if you have the stamina and the strength. I don't mind if I can spare another half an hour. But having said that, you see half of these ratios. For example, ROC we'd already covered, guys. What incremental benefit do I have? ROE, you already know, I told you this also. PAT minus preference dividends upon ordinary shareholders. Gearing, I'd already told you how does gearing affect ROC, right? Gross profit margin, operating profit margin, guys, this is foundation level. I'm sure you know this. Financial gearing we had already covered. Operating gearing we had already covered, which is fixed cost, which is related to fixed cost. Interest cover, I told you in the previous chapter, EBIT upon debt interest, correct? Interest yield we've discussed from a debt holder's perspective. Interest payment upon market value, okay? EPS, you know, PAT divided by number of ordinary shares. P ratio we've already discussed, share price upon EPS. Earnings yield, I told you, is 1 by P ratio. Dividend per share is the total dividend divided by number of shares. All of this we've covered. You see, dividend cover is EPS by DPS, the total earnings which are available to distribute it as dividend divided by the actual dividend. This is dividend cover, okay? Dividend yield is the dividend that you get versus the share price. This is the dividend yield. Total shareholder returns will be the dividend per share, plus your change in share price, because that is the capital gain. So total earnings divided by the share price at the start of the period. So if I invested 100 rupees, the share price went to 120 and I earned 5 rupees of dividend. So 5 rupees of dividend plus what is the change in share price? 20 rupees. I earned a total of 25 rupees and I had invested 100, so I made 25% return. That is what TSR means. Interest yield we had covered, okay? Current ratio, quick ratio is all covered in the working capital management chapter, and there is a one full-fledged worked example which you can take a look at your end. In fact, we've covered all the ratios. In fact, Nato, I don't think we need to cover also. None of you has replied, but I guess you all know what all ratios are there. We've already covered. See, anyways, I don't think there's a need for a separate ratio chapter. The only reason I've kept a separate ratio chapter over here is to tell you the interpretations. This will help you with all the interpretations. You can go through this chapter for all the interpretations, so that if it is asked in a section C question, you can explain all of these interpretations as some key points, right? Important distinctions. This is all, again, we've discussed this, but all of these interpretations is the reason why I have kept this interpretations. This is the only reason why I have kept this separate chapter. Otherwise, all these ratios, guys, we have already discussed. So this is also not pending, but given I have separately given in this in my notes, I just thought I will quickly cover this. Okay. So before we end this is all in this chapter. Before we end this lecture, any questions for all those of you who are online with the Nizia, Bhargav, Mehal, Ruchi? I'm not sure if he's still online. Pooja, not sure again if she's still online. Parvesh. Any other questions, guys? I will soon update the link for the working capital management on this YouTube video. I'll also share it on my Telegram. For those of you who are watching this video, have not watched the previous video, yesterday we had discussed the concepts of investment appraisal and the concepts of business finance. Okay, both of them are covered in the previous video. That too, the link is given in the description. You can take a look at that. You can take a look at working capital management, which was part 3 of this revision series ahead of your exams. And all my notes are available in the Telegram group. The Telegram link is also given in the chat box. Last but not the least, guys, for those of you who had not attended yesterday, there was this examiner report that I had showed. Which has common mistakes by topic. What are the common mistakes that students make? By topic? They are all listed. So you are to make sure you avoid these common mistakes in the examination in order to score those good marks. This PDF is also there on my Telegram. I've also shared this PDF for free, open for all, open for everyone. If you are new to this channel, not subscribed, please do press the subscribe and the bell icon so that all the future content can be. I'm going to the next 10-15 days before your exam also, I'm going to upload a lot of videos that can benefit you, including section C. Okay, that can benefit you. So please do subscribe to this channel if you've not already. And if this revision series was of help to you, do give a thumbs up, do give a like. All those of you are live, can I see a thumbs up or a hi from your end? Any questions before we end this lecture, guys? Was this revision series helpful? Of course, working capital management is pending, but that you can cover separately. So between yesterday and today, it's approximately 7 hours of content, and working capital management is another 2 hours of content. Okay. Anything else, guys? Any questions? Any questions? So that is 9 hours, and then 1 hour you can do self-study, and you'll be able to cover those 3 chapters of section A and B. So in 10 hours, you are fully done with the revision. Any questions, guys, for those of you who are attending live? Was it helpful? Please tell me, was this helpful? Anything else I can help with, or we can end this lecture? I'll wait for the next 40 seconds if there's anything else. Otherwise, for all those who are watching recording, please do like if this was helpful, and do stay tuned to this channel for more videos. Rudy has given a thumbs up. Superb. Bhargavan has given a thumbs up. He said thank you. Superb. Sorry, I'm not sure if he or she. I'm assuming Bhargav is he. Thanks, Rudy. Thanks, Bhargav, for attending both the days. Both of you attended both the days. 100% live. Kudos to you guys. Nihal has put a request. Hi, Nihal. Good to see you. Nizia has said helpful. Glad to know, Nizia. Nehal has put, sir, can you please make a video on how to score easy marks in section C? I will do that. Stay tuned on this channel. In the next 10 days, there will be a lot of videos on this channel. So stay tuned. If this video also was helpful, put a thumbs up, put a like. Super. Thanks a lot, guys. Again, Nizia, Vruddhi, Bhargav, Nehal, Mehul, Pooja, Ruchi, Parvesh also attended both the days. I'm really glad it was helpful to you guys. Superb. Thanks to you. All those watching recording also, please do share it with all of your friends so that this can really be of help. This revision is a marathon revision which will really help you the day before exam. This PDF also will really help to you all. And last but not the least, wishing you all the best for your exams. See you soon. Don't forget to share this. With all your friends. Nizia's question is, what are the important theory topics? I have, as we kept discussing the chapters, if you see my notes also, I've kept writing these are the important theory topics. For example, I have said efficient market hypothesis is important, CAPM assumptions are important. There are a lot of theories that I have said is important, where I was explaining that relevant concept. If you go through the notes, you'll be able to understand what are the important theory concepts. Having said that, as long as you've understood conceptually, and by the way, transaction, translation risk, economic risk is also important. But if you've understood conceptually, you'll be able to write whatever theories are. So don't worry. Okay. All the very best, guys. See you. Don't forget to watch the working capital management. I'm going to update the link in the description right after, and do share with all your friends who can benefit from this revision of ACCA FM 100% course. Okay. All the best, guys. And guys. Last but not the least, do not forget, as soon as you clear, do not forget to just let me know that you've cleared, and I will share your happiness. I'll be really happy. Just at least let me know after your exams are done, how did the exams go, whether this video helped or not. If you guys are watching recording, please put it in the comment box if this video was helpful, and after your exams, do let me know how the exams went. After results, do let me know. Okay, all the very best. Bye bye. See you.